I found that metal cover of that song the other day. I thought it was interesting. I kind of changed it from God to Long. You know, like they're trying to make a deal with the Longs and they want to switch places with them as the chart has just gone up over the decades. Not in the short term, not in the weeks, months, years, but in the long term. The shorts, the ones that keep shorting and keep getting destroyed, wish they could trade places with the longs. And this drop we've seen, it's only temporary. It's only something that they can take into their little fantasy world and make it fit their worldview that everything really is finally happening. But guess what? It's not happening. Calm down. I don't care how low this market goes, as long as the fundamentals are strong, I'm going to say, calm down. The fundamentals are the most important part. You got to think of trading and investing like building a house. You have to put the foundation in first before you can build it. It doesn't matter how grand of a house you're going to build, what idea you have. You have to have a solid, strong foundation first. And that's what the fundamentals are. So these people that are sitting there looking at astrology, looking at Leo and Taurus and Mars and retrograde in their charts, they're missing the fundamental part of this whole equation. And that's the fundamentals. So what do the fundamentals say? That's the first thing you always have to look at, and that's what I look at when times are like this. So I have this giant list of stuff to talk about today because it's been an interesting 2 weeks. I've had a crazy 2 weeks. I mean, the last time I did a broadcast, I wasn't feeling too good because I just had one of the worst losses. I think it was the worst loss of the year, actually, and it was publicly. It was during the Fed stream, the very first one that I've ever lost, and I got destroyed. Like uncomfortably destroyed. See, I would have been cool with a little bit of a loss, you know, because that just happens. But like getting just absolutely murdered for like 30% of your entire free cash that's rough. That's rough. I mean, I worked so hard this year to build that up, and so much of it vanished in that one instant. And I mean, that was over the span of like 10 minutes, 20 minutes, 30 minutes, whatever it was. I could have been out with a little bit of a profit too, is the irony of the whole thing. I could have been like, hey, why don't I just get out right now because this doesn't feel right? And that's what I thought to myself. I was like, this does not feel right now. The way this is behaving, you know when people are excited and when levels are being broken successfully. When they're faking out, you'll see that there's all these places where they stall. And they kind of hit this point where no matter what, it won't go above that. And it's only there for a little bit. And that's the other key. Like, it goes all the way to that point and then it comes down quickly. And for the rest of the day or the rest of the week, it's trying to reclaim that point that it hit. And how well it does that tells you confidence. Because if that happens quickly, like in 2021, if we had a huge down for any reason, because even when there's up markets, there's huge, massive downs that make people think everything's over. But if we had a huge down and it just got bought up throughout the day, you just basically saw like a check mark pattern, right? It's like a straight down, boom, and then kind of a trend diagonally up for the rest of the day. That happens in a bull market. That tells you there are so many buyers that the sellers just can't push them down, so they give up. It's like you're pushing against a force and then suddenly you kind of just stop because you know you can't do it. And the force that you've imposed onto this is still going, but you are kind of slowing down and everything is coming back at you. And that's what it feels like in the market. I mean, you'll go in, there'll be this huge drop and you can buy it up. If it trends in a direction that makes you think, okay, this has strength, then you can start going with it. And right now we don't have that. We have this environment of fear. Even the people that know what they're doing, even the people that are longs and are always talking about being bullish, even they're kind of getting bearish. So, I mean, that right there should tell you that we're getting close to something probably. Here's the thing. At first you trust your gut. It doesn't work. And then you decide to go with only logic. That works a little bit because logic helps. But things are not always logical. So eventually you start failing with the logic and you don't know why. You say, this is logical. This works. I'm so smart. Everybody that does this is so smart. Why isn't it working? I'll tell you why it's not working. Because reality isn't like that. Okay? Reality isn't just one thing that you can predict and it's, oh, that's it. Reality is a combination of so many things that you can't even comprehend. So you don't know what's actually happening. You really don't know anything. You watch some story in the news, you have no idea if it's true or not. At all, at any point, at every level. So thinking you know something is only going to get you hurt. That's why I don't ever let the market fool me like that. I know when I'm onto something that there's always the chance that I'm going to get hit, and not just the chance, the inevitability that I'm going to get hit. That always happens when you win a lot. No matter how good you are, if you have a huge winning streak, you're going to get smashed. So you have to make sure when you're on those streaks, you're moving with it. You're not just extending every single time. It's like if you were to move up a level, so you take some gains, but still risk enough to move more, that's fine. But if you stay at the level you're at or go down and risk more money to move up, that's not the way to go. I was down, it was hurting, And I was thinking about taking a break for a while, because sometimes when you get really hit by something, you need to stop, take a break, and let your mind clear before you get back to everything, because that's important. I mean, a lot of times you'll get those hits and you want to quit, or you will quit. A lot of people do. But if you don't, you can just relax and come back to it later with a fresh mind, because eventually it'll be a learning experience. So make sure you learn from those mistakes. And that's what I tried to do. And this couple of weeks, I both did the right thing and I got lucky, because every time you win, you get lucky. Like, it's 50, no matter what you do, you can only cover about 49% of anything. Like 51% is always luck, and the rest is up to you. And luck could be even more. Luck could be like 99.9% too. But at the very minimum, luck is always 51%. So you got to trade like that. That's what I was saying. So yeah, don't, if you want to make progress, you have to trade like that. You have to trade in line with your gains. You can't just keep extending yourself so that if you get wrecked, you lose everything. You have to be able to take gains. So that's what they, okay, so winning trades is one thing, and learning how to take gains is another thing, because that's very difficult, especially when you're not using a lot of money and you're buying like single contracts or a few contracts, or you're only buying so many shares of stock. You say, if I sell this right now, I lose out on so much because I only have this much to grow. You have to think in terms of like, how much do I have to grow, not how much money do I have. Because if you're going with like dividends, you're going with growth in your stock, you're going with growth in crypto, you're going to eventually think about, how many shares of this thing do I have? How many like individual parts? And how valuable is that? Because if you sell some of that and it grows even more, the extrinsic value is what you're losing on that. You're losing the fact that it could go up more in the future. That's weighted into options. That's why options trade like they do, because they factor in what's happening now, what's already happened, and what could happen. And that what could happen is a range of things, which is why I have the standard deviation channels on these charts. Like, I have this thing that has nothing, just so I can see the actual chart and what it looks like, and then I have the one with the indicators that I'm going to maximize here. So there's a reason that I have these standard deviation channels on there. And actually, hold on one second. Let me see if I can dump this grid in the background, because I don't know. It depends upon what you're looking at. Some screens you're not going to see a grid, but on mine there's a heavy grid. So I want to take that out real quick. Just go to here, uncheck it. This is what I like about that software. Oh, so much better. Okay, clear things up, because I hate lines all over the chart. That's why I laugh at people that have all these like crazy trend lines and things. And by the way, I have some trend lines, so it's not like I don't do this stuff too. But when you see the craziness, there's like so much of it, then you can't even see the forest through the trees. So I try to like minimize everything that I possibly can, which is why I only usually have VWAP, extremely important. That one just for trading. You don't have to deal with it as much for long-term investing, but for trading, definitely want to have VWAP. A few basic moving averages, like the 21, 50, 100, 200. Boom. Any of those four would be good. Hey, plebs, what's going on? Never check your bad luck charm is here. Hey. No, you know what? Nobody's bad luck. Luck just happens to flow on its own. I go through points where I don't believe in luck, but then points where I do. But really, luck really is a thing. Like there are times where you're just luckier than other times. You don't have to get into any like mystical explanation of it. There's just certain times where you're like winning no matter what you do. And those are short. And you don't realize you're in them until you're just about out of them. But you do get those streaks here and there. And usually you kind of squander them. So the trick to trading is learning how to take those and point them in the right direction. Just learn that really quick, really little bit that'll get you moving. All you have to do is earn the right set of contracts, the right set of shares. Like if you had bought Tesla in 2012 with just a little bit of money, you'd be up right now. It doesn't matter, and that's the thing, it doesn't matter what like socioeconomic class you're in and how much money you have. If you bought a little bit of certain things, you could excel greatly in the markets. And that's what you're looking for when you're trading. Just those opportunities to grab onto something with very little risk, but very high reward, because those are very, very rare. So, hey, I got so much to talk about today. I don't know how much you're going to be able to catch, but there's a lot going on in the world. And I was just talking about charts and why I think of things the way I do. And the main reason I have those standard deviation channels on there is because that shows you the range of possibilities that will most likely happen with a stock. It doesn't mean they'll definitely happen. It's just a place to start from and kind of go out from there. You can say, okay, in most cases, this is where things will move. This is the probability that things will be here in the long term. And if you can have just a little bit of that as a visual aid, it helps you kind of figure things out in a different way. Because look at these price levels. Like one of the reasons I have this right here is this is a huge jump. And you can see this was where it topped before the pandemic and then shot down. This massive candle right here, going through this kind of trauma, when all you've seen is up for a very long time, is very jarring. So prices change hands quickly in these areas. That's why there's these huge candles. I have this on weekly, so every single one of these candles represents a week's worth of time. But the fact that some of these move so quickly shows you that there was a bunch of transactions there that hurt, that people were afraid of, that people didn't know what to do. It shows you that there was a lot of pain and a lot of fear, and that's what you're trying to avoid. You're trying to let that happen and get in at those strategic times, because eventually, if things hit a certain low, they get bought up too quickly to be able to catch on to. So I mean, if you look at how low this came and how quickly this half of the gains were returned in a matter of like a month or two. That's nothing in the grand scheme of things. That's such a short amount of time. You think of how quickly everything dropped, and then how long this pump took. Like in this whole area right here, people were in denial, including myself. Extreme denial. In fact, the reason that it moved so quickly there is because people didn't think when it finally got up to its old highs that it deserved to be there, that it was overpriced for what was actually going on. But you think about what happened 6 to 12 months down the line from that point, not what happened at that point. And that's the people that were getting angry about it weren't looking at that. They weren't looking at that's a positive thing. If everything is extremely down and suddenly the market starts to rally and has record highs, that means things are going to improve more likely than not. It's that simple. It's nice to see something that will tell you, hey, it's more likely than not that something good will happen. Because if you go back in time, that's all you see is up, up, up. You don't see anything else. Look at this. I can keep rewinding this from like 2012 back to the great financial crisis, right? I can keep going with it. Goes back to the 90s. You can see in the 90s it was even lower. And this is the end of this product because it only goes back so far. But you can see that over time, and going back to like the 1920s, this is the same thing. You see it go up, come down a little bit, and then it goes even higher. And that's what it's done every single time. And people think that things are going to change. Fundamentally, nothing is wrong. Fundamentally, everything is the same or better than it was before. Because when there's a crisis, we improve the areas that were causing us problems. Like the 2008 crisis, where they all the risky borrowing and the risky lending and the way they were packaging things and the fraudulent, like the craziness that was going on during that time. They fixed a lot of that. Not that it doesn't happen in certain ways, not that it hasn't always happened in certain ways, but for the most part, the extremeness of it has been tapered down a little bit. And that's kind of what they do with regulations. They don't want to destroy things. They just want to pull like the tops down and the bottoms up a little bit. Just kind of compress everything. If you know anything about audio mixing, a compressor kind of does that. It brings like the quiet noises up and it sort of squashes the really loud things that are covering everything else up. And that's kind of what the Fed's trying to do with monetary policy. They're trying to either open it up, like when the pandemic happened, they really opened it up. It's like, look at this. This is the standard deviation channel for the entire duration of this product. And at that time, it just shot. Well, like one or two standard deviations up. That's 2 standard deviations up. That's massive in the long run if you don't realize that. That's huge because they opened the spigot. And then what happened? Well, we had high inflation. We had the consequences of going up so quickly. You can go up that quickly, but there are consequences because that money, that capital spills into other parts of the market that eventually hurts us all. There's a point in time where you can't make things more expensive because they're pumping up the prices for a majority of the population. Like small amounts of the economy are the ones that are causing this over correction in either direction of the economy. Like we have to have these crashes and booms at times because that's what happens. Sometimes you discover things. Sometimes you improve things. Sometimes you have abundance, all right? Other times you don't. Other times you have storms and things get destroyed and it takes longer and you don't have this part or whatever. It's just natural to have the ups and downs. But if you're putting the brakes on a piece of the economy that kind of controls the power to all that, or you're putting on the gas, you can really push this out of alignment. And that's what happened over the past couple of years. And that's why I was saying I don't like buying in that environment. It's so difficult when you're along to get stocks in that environment and say like, okay, I feel comfortable about that because every day it's going up. You can buy it and it goes up, but then when it crashes, you think, is this a top? Is this a top? Is this a top? Look at this. People weren't believing that this was going to continue every single time because there's these big shots because shorts get squeezed. People are overly bearish. They say this isn't going to work. And then when it doesn't drop, they have to pay up because they're paying to hold those shares. People that are shorting the market and betting on the downside are putting money on the fact that they think it's going to drop. And they're also paying for the right to do that. So if you're going long, all you're doing is you're buying some shares and you're sitting on them. But if you're going short, you're paying fees for the margin, you're paying fees for having the shares, you're hoping it happens in the right amount of time, you're adding more shares, you're getting yourself deeper into the hole. And when you're going to the upside, there's no limit to the risk. So if you're going to the downside, you can only lose the money you put in. But if you're going to the upside, you could go to infinity. I mean, it's not really going to go to infinity, but still, it doesn't have to. It could just go a little bit higher, and that hurts. So you have no limit on your risk when you're shorting. That's why people can get so crazy. And when you're talking about huge money firms, people that are putting millions or even billions of dollars on the direction of the market, you could talk huge moves. And that's why I look at the whole point of this whole thing was that's why I like looking at this chart with the standard deviation channels right here. And you can see these huge jumps. This shows you where people were really excited, really bearish, huge amounts of money were changing hands. There was a liquidity pool. People didn't believe this was going to go up because they had seen the craziness of the 2020 crash. The COVID-19 thing was the biggest thing the market's seen in a very long time. I mean, we had a big event in 2018, but it pales in comparison to that. And that's really sudden because that's seriously like just a month's worth of time right here. We lost so much in just a month that nobody believed this was going to happen. So when we got to the old highs, people thought like, oh, people are still laid off. Because this point right here, this was when unemployment was at like 20%. No, but see, that the worst things were the more people believed they were right about their short. The more people thought it's definitely going down. They weren't thinking about the fact that the Fed had just turned the spigot on higher. It's like there's water pressure. And if you want to go down, you're swimming against the current. So you have to push against that. And the more pressure they put on there, the less you'll be able to do that. So when you get to this point and they really, really short, they get blown out hard. And that causes a level change of where people go, okay, I believe this stock is going up now. Because once it's surpassed its highs, it's had its little breakout, and then it's kind of tested everything, like it tested support, didn't go below that. It went way back up, and it broke out to new highs. Eventually, people started believing. Like, I think I jumped on the chain somewhere in here. It was like, yeah, it was right after this point, right? Because I think this was when Tesla was going insane, too. That's right, from April. Oh, yeah, that was rough. I mean, that time, oh, that was back here, actually. So it's like my bad loss. I had a really bad loss in 2021, and then my bad loss in 2020 was Tesla when they were going way out of control. Before they finally corrected, where I was almost right, but that's all I was going for. I just go for like a little bit of bounce to the downside. But that's what you said. It's crazy. Trying to short things is not easy. Trying to short things is really, really difficult, and it hurts. So I don't do it. You know, some people are good at it. You have to do what you're actually good at. You have to think about your strengths, your weaknesses, and play towards that. So I think about that like, okay, this is what I'm good at. I'm good at looking for stocks that people think are dumb and are worthless and buying them then. Because I've realized there's a specific thing that happens over and over and over again. It doesn't happen every time, but most of the time, if the entire population, number one, believes something could not happen, and number two, does not want it to happen at the same time, that thing will happen. And it's like 99% of the time, that's what happens. People think, oh, this could never happen. This could never happen. I don't want it to happen because that's the worst case scenario. Well, guess what? It's going to be the worst case scenario because that's what always happens. The worst case comes up. We just see it and go, oh, shit, now we're here. What do we do about it? And that's what happens in these events. People get blown out. They're done. There's a huge price change or there's a huge level change. People start believing that, okay, we're in it, but the shorts keep denying and denying. And eventually you're just up. And the new players, the new people come in because they're seeing everybody make money. They provide the pump up to here. When you see these like massive green candles, these are shorts or the next wave of buyers. There's kind of multiple waves in a mania. There's like a first wave where the very, very early adopters, the first people that even know about it, they kind of come in. Then there's the people around them that are the actual early adopters, and they find things when they've started and are getting in right at the beginning. And then there's the people that kind of see it after it's been going for a while and jump in. So there's those levels, and after that you have the masses. You have the main part of the masses, and then the blow-off top masses. Those two levels. So you're separating the first three from the next two. Because once you get to the point where the masses come in on something, it's over. It's going to go till it blows up at some point. So you want to get in at the point where you've seen it, it's worked for a while, but the masses haven't quite gotten into it yet. So at that point, you're getting long here. In this mess, when people really like this big drop right here would have been the perfect opportunity because this kind of stuff is where the shorts think finally it's happening. I told you it's overvalued, so they go in. That's kind of what I want to talk about today. Thinking of things through the eyes of the shorts when the market is going in their direction. Because right now, even though we're having a rally, it's still going in the direction of the shorts. Because if we close lower, this will be the first year that we closed lower actually since 2018. And before that, it had been quite a while since we closed a year lower. Because even if we had a bad year, it's like right at the end of the year, it pops back up. It just tends to stay where it's supposed to stay for whatever reason. It's almost like it's rigged. Maybe if you think of it that way, instead of like, oh, everything's this whatever fantasy I've been told about the news. It's like, no, people with money are just doing what's in their best interest, and we're riding the waves of what happens in that point. Like right now, we see a downward direction. We see a year that's probably going to be down, our first down year in a while, which means the bears have won. So if you were strong enough to short the entire year, no matter what these pumps say, you're still up. There's not a lot of those people because most of the shorts are quick. Like I was saying, it costs to be a short. So not only are you betting on something that's kind of unlikely, you're also getting crushed for it the more you hold it. So it's very dangerous. You know, the people that are shorts you have to have a special personality to be able to do that successfully, because it's extremely difficult when you're seeing these wild swings. But what I'm seeing is the trend line is continuing. And every time we get to one of these levels, we kind of pause a little bit. Here we go. And we have the volume. So that was the other thing I was going to say. So I like the moving averages, I like the standard deviation channels, and I like to see the volume at the levels. So the volume profile to tell me where shares are changing hands, because that's where you're going to have support and resistance. If you look at this, people are looking, these are weekly candles. That's what I was saying before. I like looking on a longer frame timeline because it gives you a better idea of what's actually going on. The big movements of the tide, not the little whitewater tips. It's the whole tide. So in this case, we're still down, even though we've come up for the past couple of months. And you have to realize, like, a couple of months on a short is very difficult. The shorts are hurting right now. Not only did we stop, we haven't gone anywhere for a minute. So this week is going to be crucial. And there's a strategy. Like I wrote this on my notes, actually. There's a strategy that shorts tend to look at. It's short the first red day. And if you change that to the weekly candles, you get shorting the first red week as a very successful strategy. In fact, you're up almost every time. If you started at the beginning of the year, first red week was the first week, you were up, right? And so you had a couple of green weeks, and then your first red week, boom, gave you another opportunity. You had some green, even though you were trending downward, and this time you got blown out. But this was a Fed meeting. This was unexpected. This caused a lot of stress to be removed from the markets. And this was the first set of earnings that would guide things down to a more appropriate level. And if you look at that over time, what's happened since that point? Because this was where we really first figured out what was going on, right? We got hints of it while this was happening. They kept saying, hey, this is out of control because we keep having these massive pumps. Prices are going up. Traders are pumping up commodity prices, which means the people that buy those commodities and then sell them to consumers have to raise the prices on the consumers, and then they're not happy about it, so they have to get increase from their wages, and they do because everybody's making more money now because there's just more cash. And the cycle just keeps going and going and going. So eventually they have to be like, all right, let me put the brakes on this so things hopefully come down to a more manageable level without squashing labor too much. Although you can't really help but squash labor. It's going to happen. Because if you're going to stop, the whole thing is like, if you're squeezing water through a pipe, you can only fit so much water in that pipe. No matter what you do, I mean, you can make it pump through there faster. There could be more pressure in it, but you can only put so much through that pipe. So we had this, the expectations were finally kind of sorted out right here, because I was saying we're going up right here. We didn't know what's going on. They just hinted, hey, we're going to do something pretty soon. And at the beginning of the year, people got scared, dumped, and eventually we got an idea of what we were going to do. And they said, all right, we're going to start raising rates. We haven't done it for a while. Rates have been zero, meaning people that borrow money borrow it at a cheaper price. So money can enter the market easier. So it can pump up commodities. It can pump up the things that these companies buy and sell that we need to go buy. The higher those prices go, the more it's going to cost for everybody. Not just us, not just them, everybody. It just keeps going up. That's why they call it inflation. It really is like a balloon. And the economy is designed to inflate over time, but it's supposed to be inflated responsibly. That's the thing that we're not talking about here with this whole economics thing. Like, how do we do it? We do it responsibly. All right. We don't do it for just our own interest. We do it for the interest of like everybody right now and what's going to happen in the future. We allocate it properly. And when you overdo it, you get these huge squeezes, you get these huge problems. Inflation goes up by 9%. It's not supposed to happen. It's supposed to go up by like 1 or 2%. That's normal. A little bit of inflation keeps the trajectory of the market going up so that investments, so that assets you hold continue to gain value over time. That's a way of protecting you. That's how the system was designed. It was designed to protect you. It's being misused. It's being turned into something different. But if you look at the basic essentials, that system was just designed to give you some assets, let them grow in value, so that way over time you've collected something. You can show what you've gotten for the work that you've done. And if you stop working, you have something that continues to inflate. So you need some inflation. Like a little inflation is good. We all want to get richer. The way you get richer is hold assets. You buy them when they're cheap and you continue to hold them. You either sell them or borrow against them to get value out of them later. And those are both good strategies depending upon what you have to do. There's other things you can do as well. But the main point is right here, we're trying to get to a more reasonable level because the Fed knows that we have pumped things way out of control. This massive pump right here is not supposed to happen after such a massive drop. But actually it is, because the amount of pressure that was exerted here came back and had to go up a little more. But guess what? Now we're having the fallout from that. And that's what we need to have happen, because this massive set of greens right here, this massive set of greens right here, that shows you that things are out of control, because that's like, look, 1, 2, 3, 4, 5, 6, 7 green weeks in a row. That's almost 2 straight months of every single week you're up. Right? And then here's a couple of months of downward movement. Yeah, that's in September, because that usually happens in September. That's when things kind of swap around. This is a weird time. So you always need to expect, even if it doesn't happen, that this is going to be a weird time, because it usually is if you go back in time. But still, people were up all the time. They weren't used to it. This is extreme. Well, they were used to it, but it was an extreme way. So we just had to pull down the amount of cash that we're using, that we're pumping into the system. And that's what they're doing right now, because all these places going bankrupt, these shares just disappearing, this is what they mean by pulling money out of the system. It means all the irresponsible bets are finally being called, so we get to see what they're actually holding. For example, FTX, right? FTX is all over the news. Everyone's talking about it. It's this whole crypto thing. I'll talk about it a little bit later, but basically, this guy made a little company, and he said, hey, I'm going to make this token right here. And then I'm going to borrow against this token because I'm going to say it has this much value. And we're just going to say that there's billions of these things. They're it's worth billions of dollars. That's what they did. And then eventually you say, hey, there are only 3 billion of these tokens, yet you're saying you have, or 3 billion worth of these tokens, yet you're saying you have 8 billion of them on your balance sheet. Well, suddenly all that price comes crashing back down because it's not there. Because, oh, guess what? They made up their own coin and they borrowed against it. What the hell what do you think's going to happen? You can be like, how much is this worth? I don't know. Whatever I want it to be worth. Because at the time, because I made it up. Like, hey, I want it to be worth this right now, so it's worth this right now. Why don't you give me billions of dollars? And people believed it because of the pump, the hype, the mania. You could get away with that shit in this market. You definitely can't in this market. I mean, some people can, because it's like there are some really, really bad scams and stupid people and really misfortunate people as well. But for the most part, you're going to see right through that because everybody's so negative. When everybody's positive, they're not looking at this. They're not looking at the fact that everything's going to get wrecked if they're not paying attention to their money, hence BitConnect. Oh, if you get into anything that guarantees it's going to go up over time with the exact same amount of gains, and it's going to be a scam. It's definitely going to be a scam. It always is. BitConnect, and then now FTX. It's just, FTX is disgusting. I mean, the fact that they made their own token. The guy ran his own trading firm, Alameda Research, and they had a massive stake in it. He made up a fake token, and then he borrowed his own money against it. Like, you can't make this up. Not only did he make the token fake, he loaned himself money off of a fake token. And people are like, oh, I wonder why this failed. Well, that's why it failed, because he had a fake token. Oh, it's just too much for me. I love this whole story. It's amazing. I mean, where people are finally, when you're talking about trading over the long term, during this time period, all you could find was Bitcoin's going to 1 million. Everything you said was a Bitcoin's going to 1 million. Look at this guy. He ran for president. Now he's dead. You said Bitcoin's going to 1 million. Oh, Michael Saylor owns a bunch. Elon Musk owns a bunch. There's Dogecoin. There's Ethereum. Vitalik Buterin's doing things. Like, it's all you ever see. This whole, everyone's going to believe it. It doesn't matter. They won't listen to the people that are saying, hey, this is going to crash. Because some of those people are full of shit. They're just there because they're mad about everything else and missing out on gains. But the people that are actually watching this and going, this seems irresponsible, nobody listens to them. Or I should say very few listen to them, because some do. That's why you find this kind of content, because there are some people out there that are actually talking about this. But most of the stuff you see is because of somebody's agenda. Somebody's being paid to go up there, or they have a financial stake in telling you some narrative. So you have to watch out when you're looking at anything. It doesn't matter how small it is. You have to listen to it and go, okay, this could be somebody's interest. Like, they want me to short it. They want me to buy it, whatever it is. Maybe they want you to buy it because they need to get out of it quickly. Or maybe they want you to short it because they know it's going to bounce and they need people to buy and sell shares from. You know, so you never know what's going on with that kind of stuff. So I like to hear what the mainstream media narratives are, but I realize that everybody that's giving it to you has a reason. Like there's a reason these people that were pushing Bitcoin and still are trying to get the Fed not to raise rates. What do you think they bought that Bitcoin with? They bought it with borrowed money. That's why they're in trouble right now. That's why they're telling you that everything's going to collapse, because they're like, in 2020 and 2021, they're like, all it ever does is go up. I better borrow some money and buy it right now, and then I'll make a bunch of money. And they do. And everyone's like, how are you such a genius? And they're like, oh, we're stupid. That's how we're a genius. And then nobody listens to it. They just keep going. And then the market does this, and they wonder why it does this. Yeah, because some guy borrowed a bunch of fucking money and bought Bitcoin with it, and then Bitcoin crashed. Well, what happens? He has to pay that debt back. That debt eventually has to get paid at some point. This is real shit. You know, this isn't some Monopoly set. So eventually these people are calling in their loans. When they see some stuff going down in the market, people want their money back. So they call them in, and those people are like, oh, we don't have it because we borrowed money. Who'd you borrow money from? We borrowed it from you! Oh, well, shit, we're out now. That's like the story of the market right now. The responsible ones that don't do that are still here, and they're fine. I mean, they're the big businesses that have been running forever, not the big businesses that are going crazy and crashing right now. That's how you tell. Like, there are good companies that have been around for a long time, and there are terrible companies that have been around for a long time. Not as many as the good ones, because over time, eventually your shit gets you killed at some point and crashes your stock. So eventually, these people succeed, and they figure out how to do it, and they do it over the long term. There are also people in the short term that are really excelling and might end up being those people of the future. But there are also a lot of bad ones, too. And we're finally seeing a correction. That's the thing that I love about this. As much pain as we're feeling, because believe me, I'm feeling the shit. It's bad, right? I feel like my long account, it's been down for a while, but even with this bounce, I'm just like, oh, God. If we go down lower, if we get another one of these legs, this is just going to be psychologically damaging. But I'm good. Like, as long as if we're in this range, I'm good with that. And we could go lower, I'm still good with that. But that doesn't mean it's gonna hurt, or it's not gonna hurt. It will definitely hurt. No matter how good you are, it's going to hurt. When your money goes away, it sucks. It's like, it doesn't matter how much you have. Just watching that happen really sucks. So right now, I'm watching a lot of it disappear. But the good thing is, finally, I could say, hey, I had a really good couple of weeks. I made some great trades. I lost a whole bunch of money at the beginning of the month on a gambling day trade. It was at 4 out of 5 I won. And this was the one that I finally lost. And I never bet big enough to blow myself up, ever. But when I look at something like that, I was willing to risk a little bit more that time. Not enough to kill me, but definitely enough to hurt. And that hurt bad. So I really didn't get over that for a while. So the last podcast I had, I was still hurting. So I kind of gave you everything in a pessimistic viewpoint, I guess. But at the same time, it's necessary because you have to see it through that side of the market sometimes, too. So after that, I ended up coming back and making a few trades that went well. And these were actually trades that I had been making for a while because I was expecting this bounce. When things get down to about here, they're starting to slow down a little bit. I think, okay, we might be gearing up for a bounce because we had so much red action. We're not going down farther. We're touching a weekly moving average, which has a lot of weight. So we're still up. And we're above where people were in the pandemic, where people got in during the pandemic. Because now here's the thing. We're at a part where a huge amount of shares changed hands. So the reason I was telling you about this big price discrepancy here was because it's important. It shows you a point where there was a real flip in who decided they wanted to own everything. Like, people really didn't want to own stuff as this was going up. This was basically a select few bulls that were doing really, really well and a bunch of bears that were fueling them. You know, and people making little trades and things like that. But most people were thinking, this is going to drop at some time. And when it got halfway up there, it stuttered for a while because that's insane. Feeling this pressure and then seeing this much, you're like, no way. And we get to here when unemployment's like the max. People don't think it's going to keep going. Well, yeah, guess what? It's not going to. But 6 months from now, this is where it's going to be. That's what it's looking at. It's not looking at right now. It's looking at here. So when things are down and you see the stock market rallying, that's a good sign that things are going to rally soon because it means they're looking at a point in the future in which this could happen. And that point is 6 months to a year. That's basically it. There's more than that. There's less than that. But that's the main trajectory of the entire market. They're all going towards a single point in a trend, not in a perfectly linear fashion. Things are going to go up and they're going to go down, but we can see an upward trend. And most of that is because of inflation. And this right here caused a huge change in who's owning it. So we can see a different mindset behind that. So the people that bought in right here have never been underwater. they've been up the entire time. And we're finally getting down to a point where those people are feeling the pain again. And that's not something you see in a market that's going up forever. They haven't known what to do. So now that they're being challenged, some of them are panic selling. Some of them are thinking, hey, it's finally time to buy, which is kind of what I'm doing. Because I think even if we go lower, if you're just buying little bits and you don't mind losing whatever it is you put in, then eventually when things bounce, you're going to be glad you did, because all you can think about when things are going up is, crap, I wish I bought more here. I remember this very day, the actual bottom day, I had problems with one of my trading accounts, so I couldn't buy things. Bitcoin was at like $4,000. I mean, all the stocks I wanted were super cheap. I could have just put a couple $100 around, and it would have been amazing on that day. But my account was locked because of some error, so I couldn't do anything. This was the worst. If I had just been able to buy a little bit of that, I would still be insanely up right now. I wanted to. I was ready to, but man, I was still learning things, and I just didn't know what to do in that situation. I mean, that's why you have multiple accounts and why you have your money spread out in different strategies. It's just so much better. It's so much better that it's so much easier to sleep at night when you realize that you have money doing something different than what you're concentrating on. If you're looking to trade, it's good to have some long exposure so that you don't have to think about things as it's going up. You can go like, all right, I'm not making money on these other things, but at least that stuff that I buy every so often continues to go up, because it does in the long term. So this is why, because asset appreciation. That is the reason the Fed wants some inflation, but not none. We want asset appreciation. You want your house, your car, your stocks, whatever you own to go up over time so that the work that you did to get it pays off. That's the whole point of the system. It's not supposed to be some system that screws everybody. That's because there's corruption. But the core of the system allows people to just float with the tide and be carried to whatever prices are available at the time. So you want to hold assets over time that you can afford with money that you can afford to lose, because if that turns into something real, you wouldn't have been able to do anything with that money that would be better. Like, let's say you take your $100, right? Just take $100. What are you going to do with $100 in the next couple of days? Like, you'll get some food, you'll get some gas, you'll get whatever. You'll take care of the things you need for life, and it's just going to go away. But if you took that $100 and you put it into something, 20 years from now, that 100 could be thousands. Right? Like, even if you think about buying a candy bar, buying a meal. I remember one time I went to Wendy's and I was going to order some stuff, and I ended up turning around and going home because I thought, every time I come here, I spend like $30 getting all the things that I want. When you don't do it a lot, you got to get everything, which they count on, because that's how they get you. You have to pay so much for all those sticker items. And that's all you want. You want the sticker items. You don't care about the stuff you know is of value. The same stuff put in a different shape is like way cheaper, but you want the picture of it. So you go for the one with the picture of it. You could just be buying the other things, but you're like, no, I don't do it very much. I got to get the presentation too. And then you're disappointed by the presentation. So you wasted the money. You could have just put it in the stuff you knew was a good value, and you would have been happier because your expectations would have been low and they would have been let down. But that's how these companies make money. That's how they're getting record sales, because people feel bad. They want to go buy a Big Mac or whatever. But anyway, one day I go to Wendy's and I thought, okay, I spend like $30 here usually. What if I go home and just make some food with what I have, and I take that $30 and I buy some crypto with it? I did that, and I ended up like turning that 30 into like 50 or something within a couple of days. And I didn't sell it. I just kept it going in that crypto. But I thought, I could have had a sandwich and that money would have been gone. But I put it into something and it turned into a little bit more. And an extra $20, is it nothing? I mean, you can get something for that. It's nice to be able to have money that's growing on you and isn't just taking from you. That's what you're doing. You take money, you buy something, and then there's a cost, right? Like, you eat that hamburger and you don't feel good. It actually does some harm to your body unless you're eating it responsibly, which like 90% of the people that go there aren't. And I'm off on another tangent here. So yeah, I had a few trades that went well. Let's take a look at that. GPS. GPS is gap. You can see over time, even though the chart goes, or the standard deviation channel is going up, it's still kind of sideways because we're in a serious downtrend right now. And stocks like this are nice for me as a little trade because their options aren't that expensive and they can have these big moves without going insane out of the range. So basically, what can I buy with low amount of risk that has a high amount of upside? Stuff like this. It's like I bought these contracts at, I don't know, $30 a pop or something. Actually, the average was $30, and so I was buying it for less than that. And these contracts ended up going to like 120 or something like that, 140 when they peaked, because Gap and its affiliates did well. I mean, they did well enough. They had exposure to Kanye West, and that whole thing's been crazy. So that whole brand cost them like millions or billions of dollars. Even with that, they did well enough to where the stock squeezed. I mean, they were able to sell enough to do better than people thought. They guided in line, actually a little bit up, maybe. I don't really know. I haven't finished looking at everything yet, but I'm judging by the way the stock behaved. They must have guided well. It's either in line, okay, here's the worst it could be. It could be down within the projections that they had already put out. That's basically a baseline. So if it's down, but they already told you it's going to be down, that's like the lowest set of support you could have for something negative. And then there's something like it's going to go the way that you thought it was. So everything's going to be flat. That's also the same thing. It's support. It could be a little bit positive. It shows you, okay, they're still in line, so we can trust their guidance a little more. Traders want to know, how well does your guidance hold up? If your guidance holds up well and you're trustworthy, then they're willing to put a little bit more down when this kind of stuff happens. And just because of that, just having that extra capital protection can move it up a little bit because the shorts don't get the opportunity to go down as far as they'd like. So they have to buy to cover and things shoot up. And it's kind of what we have in these stocks, which is why when it was down here, it was a few months ago, I was looking at these, it was actually probably in these last couple of weeks right here. Because when you see a massive downtrend and a bunch of red right next to each other, you have to think, okay, this is probably going to bounce soon. So I ended up buying stuff for a bounce, and then after we bounced, we had a good, we ended up having like a good CPI number somewhere in here. We bounced even more. So I basically just bought these at the best point in time. They quadrupled in value, maybe more than that, and I let some of them go for around that. You know, like I could have gotten a little more on one of these, and I wish I'd kind of held them till right after the thing, but I wouldn't have seen them crashing so hard. So I'm kind of glad that I sold, because basically by the middle of the day, the contracts that I bought and that were up and I sold before the earnings came out were right back to the same level. I thought, you know, after I dumped those contracts and then I saw the earnings shoot the stock up and it stayed, you know, because you'll see it like move up, but is it going to stay there? It shot up and it stayed. And I thought, okay, these contracts are going to be worth so much more tomorrow. I messed up by selling it. But no, they were just about where they were. So it was just fine. I did really well on that one, actually. I don't have to worry about it so much. So what do we got here? Artisan Emotion of Love. How such a good call with Apple last week. Looking to do it again, but it's hella volatile. Yeah, Apple is super volatile. Everything's super volatile right now because Apple's heavily weighted to the market. That's one thing you have to realize with this. If you look at a stock, it's not moving on its own. It's moving because of the market, and it's moving on its own. So it has like a main trajectory, and then it has little movements based on what it's actually doing. Because think of it like it's clinging to a branch of a tree. It's like a leaf on a tree, and it's doing its own little moving within the leaf. But the entire movement of it is coming from the branch. And that's the part that Apple can't control. That's the part that's weighted to the indexes that everybody is looking at and are being traded on. So a lot of futures and options, even the VIX, that's all having to do with people trading on those things. So they're taking that capital and using it to squeeze the stock sometimes. And when you get something like this where people think it's going to crash and they just come by with we're doing okay, or we're doing bad, but not as bad as we thought, that's enough to shoot stuff up. But Gap did well enough, even with all that stuff, that it shot up. So I was able to make a little bit of money on that on the pump. When things were way down here, I was thinking it's time to buy, because this is when it's time to buy. I don't like buying in here, even though you could have bought it any of these days and been up quite a bit, or I should say any of these weeks. I don't really like buying unless there's a huge downpour, because I remember buying some of these and then selling a little bit in here, and when it dipped down a bit, I bought a couple more. But that was just a dip buy, something that I knew I could afford and it wouldn't be a big deal, and it ended up paying off. But usually I want to be all in, or not all in, but as in as I'm going to get at this point, and let the wave just take me as high as I can. Like, take a little bit of profit, make sure you get whatever. It doesn't have to be exactly what you put into it, because people say like, oh, take what you put into it out. Maybe. It depends upon how much you have to trade and how you're able to trade it. If you're only able to trade a little bit, you can't take profit sometimes. Like there are times where like you can only buy one Tesla contract or something like that. How you can't split a contract. That's it. So people with a certain amount of money can't take a little bit of wins. But if you have a bunch of money, then you can take little wins here and there and let quite a bit continue to grow. Tesla would have been a perfect stock to do that in. You could have sold a share here and there, and yeah, it would have sucked because you could have made way more later, but you still would have continued to be up. You would have been able to take money off of it, shave some money off of it, and have it continue to increase in value. An asset that increases in value over time. That's the important thing. That's what I want to get. I want to buy assets. So when people were selling assets and everybody thought it was going to be the end of the world, I thought, okay, this is the time to buy. So I bought a bunch of stuff. I bought FedEx. I bought Gap. I bought some stuff on the general market. And all of it paid off, basically because of the CPI. You know, I was already as out as I was going to get. I'd already been buying, so my cash was low. I could only do a few things, and I did them, and they ended up paying off, which was amazing. I've been rambling forever. There's a comment right here I haven't looked at. It says, I'm thinking some puts are looking good, actually. How I need to go down by the fundamentals, by the fundamental analysis. Yeah, definitely want to have both. Like, I'm not saying you can't use technicals, because that's what I was trying to get to after that. It's like, technicals are a very important point. That's why I say I do have some technicals on the chart. That's what this is. This is technical analysis. This volume profile, the standard deviation, these moving averages. That's all technical analysis. And actually, I put some price levels in. Take a look at that. I have some levels. I put some price levels in. I know I make fun of that all the time, but this is why I did it, because this is a weekly timeline. And if you take a look at that, these correspond with volume levels, and this one just corresponds with a low. I just kind of put it down there. But you can see where the volume is high, it tends to come back to that point and then pivot off of it, or get fuel off of it. Like this point right here. It hit this point after consolidating for a while, and then it took off because something allowed it to pop. And where did it pop to? This little area of volume. See, I kind of just lined them up with the middle of the volume, so they're not actually weighted to the price side, they're weighted to the volume side. Like electricity or anything, it's kind of like a wave. It goes back and forth around a point to form that thing. You think it's a thing? Like, no, it's a thing that's moving back and forth around a point that is the thing. So that's what this is. That's what volume is. This is where most people are. So you're seeing people that are afraid, people that don't care, people that are in the middle. They're all going at it at this point, and it moves it so quickly. And eventually there's going to be a point where it kind of settles a little bit. And that's why I have it on these high volume points, because that's where most people are. And if it moves up, that could be where it goes to. This is a good point for a bounce, and I could see it moving anywhere down here if it drops, because look at how big these candles are. This is high volatility. These are shares changing hands at a massive degree. There's some consolidation in parts where there are a lot more people, but then there's some quick movement too, because this kind of corresponds with low volume area. So not a lot of people are here to stop the flow of sellers or the wave of buyers. It's very easy to get past this point. So when there's something that makes pressure build up, because it does build to a top where most of the people are, and then it's like, okay, do we have enough pressure to continue? And in this case, yes, we did. Even though we came back down just like we had before, we got the same thing right here. It hit a point where it bounced up, and now we're looking at the strategy that I was talking about earlier, the first red day. Okay, so if you're a short, you're looking at ways to try to go against the market. When is it going to drop? It's easy to buy something and have it go down and feel bad. So wouldn't it be nice to be able to short things? Because every time I buy something, it goes down. And these people are right sometimes this year. In fact, they're very right. But a lot of them get in when it's too late. You want to be getting in during this stuff, and you want to be getting out somewhere in here. You don't want to be getting out when things are starting to come back at you. You want to think like, man, we've had weeks of red. I need to just get out because this is great. You might have opportunities to get back in, but seeing something like this is rare. Or seeing something like this, if you're long, is rare. So there is a point where people will get out, and these high volume areas are that point. So I like to highlight them just to see what's going on. And take a look at this. They're also lining up with moving averages. They're lining up with standard deviation channels. Like right now, we're hitting a point at the standard deviation channel, and there's some moving averages around that are supporting us. So, and we have low volume right above us. I do think that there's a possibility that we move up a little more before we have the correction that brings us back down. So you were talking about you think there's going to be you want to get some puts because you think there's going to be downward motion. I actually agree with you. The question is, when is that actually going to happen? Because you don't know at any given day if this is going to be it. Is this going to be the point where it falls? How do you figure that out? Well, you look at the points where they move the most. And the points where they move the most are low volume areas, high, like big candle areas, places that are around moving averages, things that traders would be looking at. So there's pressure for people to get in or out at these places. That's what I'm looking for. And I think if we get a little bit more upward pressure right here, we can exhaust some of this from the bounce point. Like there was a reason things bounced down here. What did they bounce on? They bounced on look at the 200-week moving average. That helped it down. That's a huge technical trading indicator right there. And it was just right. It was by a standard deviation level. I mean, there's so much pressure right here. And it could have gone down because there's low volume. But we just lost so much, and we'd have so much downward movement that people that were short needed to get out. And people that were long had been buying, so shares started to get scarcer and scarcer. That's what you see at these points. These are scarcity points for shares. When things turn around, you get either nobody wants to buy or nobody wants to sell because they're either making too much or they're losing too much. Whatever it is, you get a point where the direction of the shares changes. And is it the buyers or the sellers? They are kind of like in a wave. Like one starts to go for a while, then the other one takes over. And right now we've been in a bull rally since what? October? Is that when this is? September? Yeah, the end of September, which, what do you know? That makes sense. September, we had this huge drop. We had a bunch of craziness in September, but we also have moving averages. We have technicals. We have fundamentals. And that was what I was saying before, is the fundamentals say we're okay. The fundamentals tell us that actually everything is going according to plan so far. Even though things are worse in some areas, the overall technicals say we're okay. Like, do we have money? Do we have what do we have for debt? When does that debt due? Is it something that we can overcome over time? And is inflation moving down? It might be. We got our first positive reading. We got our reading in the sevens. That hasn't happened in quite a while. We've been seeing it drop very slowly, but it's been like it drops by 0.2 or something, or 0.02, whatever it is. I don't even remember. But this is a nice drop from where it was going into the sevens when the estimates were at 8. Like, beating the estimates was very positive. So the market's rallying because of that. It's also rallying because of what the Fed said. They were just hawkish enough, just dovish enough to make the market do what it wanted to do some more. And the shorts are still getting squeezed. And the point what about the first red day thing was right here. If you shorted the first red day, you were always down. Whereas what I was saying before is if you went for the first red day, like first red day, short it, you win. You know, there's a little green, but first red day, short it, you win. But over time, first red day, you got destroyed because of the Fed meeting. So this one you had to take into account that was different. There was actually something massive happening at that point. But when you got up to here, there was a bunch of volume and there was earnings. There was more going on, and there was the reality of what the Fed was saying. So once you got the shorts out, everything started to go down because businesses were guiding down. And the companies are basing themselves on those businesses. If a business says, I think later we're going to make this much, then the stock price adjusts to that. Because it's trying to be attractive to buyers, to longs, people that want to hold this for a long period of time. Like, why should I hold these shares? Well, because they're going to appreciate in value by what we estimate to be about this much. That's what all this stuff is telling you. You don't have to get too into the weeds to figure out all this stuff. All you have to figure out is this is a prediction of where things are going to be in the future based on the performance and the economic conditions. So what does the company say? What does the government and the Fed and the whole business landscape say? You know, like the tide. What is the tide saying? What are the little changes in the tide saying? And right now we have pressure, if you're betting on these first red days, for shorts to be insanely underwater. So I do think that there's a possibility we have a little bit more of a bounce before we go down because we're still raising rates. The question is how much. Right now it's looking like about 50 basis points, but it could be 75, it could be 25. We really don't know. And I think the reason we're bouncing is because people are seeing the end of this thing. Every Fed meeting that continued to be 75 basis points was telling and saying that the next one was going to be was telling you that things weren't getting better. They had to hit a point where they felt confident waiting. And this is what it tells you. It doesn't matter what all the other stuff says. It tells you that they're confident waiting to see if this is enough. Like when you're turning the water on a hose, you look at a point where you go, okay, that's just the right amount of flow to where I don't have to stand there all day, but it's not going to blow the plant out of the ground. You get that right mix, and that's what they're trying to do. Did we get the right mix? Because sometimes you turn it to a point, and then you wait. Like the heat in the shower, right? You're trying to make the shower hotter. You hit it to a point, and then you wait. Did I do it? Is that it? No, I got to turn it a little bit. Okay. Did I do it? Is that it? That's what the Fed's doing right there. They're just turning the knob enough to see if they did it. And because they're talking about going down a little bit or reducing their increase, I should say, because they're still increasing, but just saying that they're not going to do as much is telling you that, like, okay, they kind of think that maybe they've done enough because we're seeing a lot of layoffs, right? Chef Brandon earlier was talking about layoffs and buybacks. And that's what businesses are doing. They see that there could be a chance for things to drop. So they're trying to take advantage of that quickly by, number one, laying people off to offset the amount of money they're losing. And number two, buy stock back because they have to get in before new tax regulations start taxing these buys. So there's incentive for companies to buy this year. We still have a month, a little over a month left in this year. And that's a chance for companies to get out of things, to move their positions around, to adjust their stock prices, whatever they do. And that's also a chance for everyone else to take advantage of that and buy some stuff really, really cheap. I've been through a tax loss harvesting year that was successful, and it was amazing. I haven't seen one since. I'm hoping we get one this year because I haven't seen a down year since that year. That was the year the year I started trading, because I'd been kind of interested in it before that, but I didn't really get into it until about 2018. And that was the first year that we saw everything drop. So going through that and going like, oh, okay, things really can drop. I was really pessimistic going into the uptrend. And it took me forever to believe that things were going up. You know, and luckily I figured it out before we hit the top, but sometimes you don't figure it out until the top, and you end up being those people buying Bitcoin at 20K back at the end of 2017. You know, that hurt at that time if you were that. But hey, guess what? If you did that and you held the whole time, you're finally back up. But how many of those people do you think held? I think very few of them did. I think a lot of them sold down there at 3,000 because they couldn't take the pain anymore. They bought Bitcoin at 17K, let's say, and they just saw it go down and down and think, oh, it's going to go up eventually. Well, months and months and months of it going down is really it's stressful on the psyche. I mean, that can cause people to do anything. So they sell, and then later on it ends up going up, and they go, oh, God, I can't believe I sold that. I could have made so much money. But that's human nature. That's what happens. That's why these trends go this way, because masses of people do the same thing. I mean, there are always contrarian bets because that's how you keep the market going. You have to have people to sell, people to buy too. But if you get everything in line, eventually you're going to see a trend. And what we've seen is a downward trend, which tells me the bears are up, which tells me people are down on their positions and they're thinking, okay, I might have made some money over here, but they're going to tax that next year. If I have a loss to offset that, I can make it so I don't have to get taxed as much and get to keep more of my profits. I'm already down on these stocks that I don't believe in, so I might as well sell them. Because even if it goes up a little bit, I don't think it's going to go up that much because of the fundamentals, because of XYZ, because of the chart, whatever you want to say. But just something you don't believe in, and it's usually stuff that's been crushed more than the overall market. Like if you look at Apple, you were talking about Apple earlier, it's down, but it's not down that much compared to other things. I mean, compare Apple to Bitcoin. That's a huge difference. Apple's not down that much at all compared to Bitcoin, but it still hurts. I mean, people are still hurting right now. So these little stocks that were doing really well when everything was going up, when there was so much hype behind them, they're the ones getting crushed. And then the sectors like cannabis and cryptocurrency and things that were really speculative, they're getting crushed right now. So it's incentive for people to sell those since they're definitely down. There are very few people that are in those sectors that are profitable right now. So it's safe to assume that 80-90% of the people in that are underwater, and they're thinking of selling to offset the trades they did make that were good, or just selling because they can't take the pain anymore, which happens. And once all those people are out, the stock can kind of go up again because nobody else is willing to panic sell. You need liquidity. And when you have giant moves, like really big entities can't always trade. Like if you don't have that much money, you can go and trade anytime you want. There's going to be liquidity there. There's going to be value. You'll be able to put some money in and get something. But if you're trying to trade millions or billions of dollars worth of something, there may not be that much supply to buy or sell to. So you have to wait for events, liquidity events, in order to do that. And these changes in price are actually liquidity events because these volume spikes right here mean a lot of people have them. Mean a lot of people would be willing to sell, or a lot of people want to buy because there's so much hype about it. So there's a liquidity event for big players to move the market. And that's why these candles are massive, because the movements that normally happen, and then the larger players get a chance to come in or get out, and they do. Boom, boom, we get a move. That lets people wait. Right. So a couple of weeks ago, I said something about the smart money and it's the big trades. And I was talking about how that's dumb because there are also stupid people that have a lot of money too. Well, that's true, but it's also like, it is also kind of true. Like the big movements are some of the smart money sometimes. But the ridiculous thing is you don't know which moves are the smart money and the dumb money. And the smart money doesn't even know if it's smart money or not. Like they're gambling too. Everybody's gambling. There's people they're doing it responsibly and they're buying things because they did all put all this planning into it. And then there's people that are just buying stuff because it's funny. That's why the market moves a lot, because it was awesome to buy this stuff and I made some money and then I sold it and now, I'm doing whatever. So right now we're at a point where shorts have been squeezed hard. If they still think they're going to go down, because I think it's going to go down, I think a lot of people think it's going to go down. But 6 to 12 months in the future, do I think it's going to be this low or lower? I kind of doubt it. I think 6 to 12 months in the future, we're going to be looking at a stock market that's up, because 6 to 12 months in the future, the market will be looking 6 to 12 months in the future from there. So it's looking 2 years in the future. So if you think it's going to be good then, you think it's going to be better in 2 years. And the market's going to be pricing that in, and it's going to be going up because of that. So even if we're hitting a bottom, we still might be bouncing in the stock market. There was a study that said the economic data bottoms usually let's say 4 to 6 months after the stock market starts to rally, because that's what they're looking at. People are looking at the fact that things are going to be okay. Like people with degrees and more money and more resources than any of us are looking at what's going to happen with these specific things that they want. Even though they don't know everything, they might know something. So the fact that it's going up tells you that it's probably going to be better, because somebody that looked at the shipping problems, that looked at the manufacturing problems, that looked at the availability, looked at the price, looked at the way we can actually buy and sell it, if anything else is affecting it, those people know that it's going to move in a certain way more likely than the rest of us. So taking advantage of that, yes, is good. And when you see a trend happen, not any specific large trade, I might add, But if you see a trend and those large trades are happening in that trend direction, that's something to look at to say, hey, maybe there's some thought behind this, because there's liquidity events and people with money want to get in, because the people with money don't have to get in. You know, a liquidity event can come and they can say, no, I don't want to get in. I'm not looking at that. So it's not like it has to happen like that. That's why when you see it actually happen, it means that they're choosing to do it. They're thinking about it. They're going, okay, I think this is what it's going to be like in the future. So I'm going to put this down because all my resources tell me this is the best bet to take. You know, so that's why I think we probably could go down a bit in the short term, but I think the trend may be resetting. The problem with that though is we still have so much to overcome. We're still going into an actual recession at some point. Like there's like a technical recession and then like a felt recession. You know, I don't know. This topic has been done to death, but in my eyes, there's basically one that shows up on the charts, and even if you may feel that a little bit in real life, but most of the time you don't. It's just something that people talk about, and it's more a state of mind than it is an actual problem, because everything's the same. You know, there's still product in the stores. You still do the same things. Nothing's closed. Like there's that kind of a recession, and then there's a recession where people are losing their jobs. You can't get stuff anymore. Things, you know, real actual recessions that cause problems and blockages and things like that. So right now, it looks like with the fundamentals, we should be okay, but we have a high risk of going into a real recession. We've hit a technical recession already, but now it looks like maybe we're bouncing, and that's a possibility too. This could have been the bottom. I don't think it was, but it's very likely that it actually was the bottom, because 6 to 12 months in the future, we might be okay. I mean, the shipping problem has kind of eased. That's not so much of an issue anymore. I don't hear about it as much as I was, and a lot of those problems actually have been cleared. So that's a huge that helps inflation quite a bit, because inflation was being bogged down by people's inability to get certain goods, and it was also being bogged down by the fact that there was so much money going into the market, and you know, we've stopped that. And I think we are seeing the effects of it. So these rates that started, or these rate hikes that started back here, took a while. They weren't being felt here, right? People already had all the borrowing they'd done at this point. You know, there was like, if you knew something was coming, you were going to get the money that you needed to get quick so that your interest rate stays at that low point. Because anything you want to do now that requires interest is going to be way more expensive. Like back here, the average mortgage rate was like 3 to 5%. And up here, it's in the sevens. You know, like some places it's even higher than that. Maybe it's in the sixes for some places. That's still a huge. That's doubling from where it was before. Basically, it's twice as expensive to borrow money at this point. So that's going to tell you some people just aren't going to want to do it, because number one, it's going to price some people out of the market, and number two, it's going to make people feel worse about the trade, because how much something costs has a physical cost to you. Because when you buy something and it's expensive, like, you feel that somewhere in your body. You get an actual reaction to that thing, you know. And so having that reaction at a certain value will cause investors to step back, because that physical pain becomes enough to make them go, maybe I shouldn't do that. You know, that's how like the mental and the physical are tied together. And right now we're at a point where like shorts are underwater, people are nervous as hell. The fundamentals look okay, but we're starting to get layoffs, we're starting to get things like that, things that you would see in a recession. But that tells the market we're going in the right direction. So right now we have an economy that's on the decline, most likely because of what we see. And it's very unlikely that it's not for a little while, but we see a market bounce in the short term. At some point, the reality of that decline is going to pull prices back down. The question is where? Have we already started? Is it going to go back down to here? And how long is it going to be? Are we going to pull it down below this point, or are we going to bounce in here? Either one is extremely likely. The people that tell you this S&P is going to go to zero, no, it's not. This isn't FTX, right? This isn't Sam Bankman-Fried. We didn't make some fake-ass currency and then borrow against it with our own money. No. This is everything. This is like, these are actual companies making actual things that have value. Stuff you're using right now. The things I'm using to stream this broadcast. Like, those companies are in here and they have value. So eventually they're going to hold at some point. If FTX had fake stuff, so when you really needed if you needed to put the assets to the paper, that's really what it is. Like, you have assets and then you have paper on those assets. When you're dealing in the markets, you're dealing with the paper. But if you have the actual asset, when things go down, you have multiple options with that asset. You can sell it, you can borrow against it, you can use part of it, you can whatever. You can hold it. There's always something you can do. But with paper, eventually it becomes worthless. Sometimes things can move in the market and make the paper worthless, but the asset is still there. So it's good to have an actual asset. But the people that are holding paper are extremely nervous because they don't know what's going to happen right now. We have low volume above us. We have huge candle moves. We have fundamental positivity in some ways, but we also have the reality of that fundamental positivity lagging behind. And it's going to lag for a little bit. So my guess is with the pressure here, if we don't see some downward movement quickly next week, which we, maybe on Monday because we kind of finished a little down, maybe we'll see some panic there. But if we don't see some movement within too much time, we could be looking at another leg higher. At this point is where the volume starts to get a little more intense. So I can see coming up to this 4,100 area, because we're basically just below 4,000. I can see us pumping above 4,000 by a little bit, maybe hitting these moving averages, maybe hitting this high volume area, and then sputtering out and going like, okay, we realize that people are actually getting laid off, so fewer things are going to be made. Fewer workers means less productivity. Less productivity means less revenue, and less revenue means less profit. So the stocks that trade at a value of what's the profit going to be have to reflect that. If the company says, sorry, we think we're going to make less than we thought we were going to make, the stocks have to go down to match that price. That's what they're trying to do. They're trying to be an adequate indicator of what the product is actually feeling at this time. So that is going to eventually bring it down without this rally going on forever, because of the fact we're running into so much volume here. Even above that, it gets more and more intense as it goes up. So I seriously doubt we're going to have a rally to the top by the end of the year. I mean, we have a month and like a week or something, right? Because I'm pretty sure Thanksgiving's next week. So we're getting to a point where the year is almost over. And usually there usually is a market during that week. I think it's closed on Thanksgiving, but there's like a half day on Black Friday sometimes. I don't know if they're going to change that or what the deal is, but there's going to be some trading on the week. It's going to be very light volume. I wouldn't put too much stock into what happens that week because a lot of traders aren't even in the market. Like that, fewer traders means things can move huge, but when everybody else comes back, they're going to react to that. So there could be an overreaction because of that week, but whatever you see doesn't necessarily mean it's going to be a thing. But what I'm waiting for is the Santa Claus rally, which can happen by the end of the year. And what we got here, Chef Brandon, Wednesday is the FOMC. But the next rate announcement is going to have a summary of economic projections with it too. So that's going to be an important event. We're going to see, number one, how much are they going to raise the rates? Is it going to be that 50 basis points that we think, because that's important? Or is it going to be something different? And have their summary of economic projections changed since the last one? The ones they put out in September basically said they were a little bit more hawkish than they were from the previous cycle. So are these ones going to be even more hawkish than that, or are they going to be in line with what they said in September? So far, the Fed says, we're going to be a little bit above that, but that's to be expected because that's how things have gone with the data. So that's what I'm expecting them to say. And maybe you're talking about the minutes or something like that, because the minutes from the meetings come out way later. And most of the time, I don't give the minutes that much weight in how much they're going to move the markets, because it's basically just a printout of everything that you saw. And yes, it's going to be some stuff that you didn't see, because the stuff that takes place behind closed doors doesn't have cameras, it doesn't have the same recording process and blah, blah, blah. But there's still going to be mostly what you've already heard. So it's not going to surprise the market enough for it to go crazy. Now, if something came out like really shocking from those minutes, yeah, for sure, it could definitely move the market. But for the most part, it's not something I even really want to trade. Like it could spook. You're right. It could spook the market. Maybe somebody said something in a certain way during the closed door meetings and a different way out in public. So when people hear the mismatch, they get afraid. They get scared or something. So that makes sense. But a lot of times that's not what happens. It's just like, okay, we already know what they said. We already know what everybody's sentiment was. But it does tell us, the vote, like how they voted. So we get to know, okay, everybody was in line, or, these people weren't, and what they thought about that. So that's kind of nice. But I'm not waiting for that. I'm waiting for the next meeting more so in the middle of December. And I'm waiting for the end of the year tax loss selling thing. And then earnings are pretty much over. Like we're still going to get some earnings for the next couple of weeks, because there's basically earnings all the time. The entire quarter has earnings of some kind, but only the companies you don't care about, right? Like the companies you care about are in a very specific chunk, and the rest of it is just what happens afterwards. So I don't get involved in those very much. I basically try to get in on the big moves and get out as soon as I can, because I don't like trading the little stuff. I want to take the stuff that's more sure. So right now, I'm wondering if it's going to bounce or if it's going to drop. It could drop. We got to see what the performance is next week. If it performs well, then I can see us going up. And well being like not dropping, maybe even just trending up a tiny bit. Like a very slight uptrend from here. Like if you saw this kind of a candle, but it was green, that would be extremely positive, because it would show you that it's not dropping. Minute by minute, the shorts are getting more and more nervous. And they're the ones that are going to send it flying because we have so much disagreement right now. Like when people see things going high off of lows, they know it's going to flip. Because look what's happened every year, every time this year. We have this big shot, and then we have a drop. We have a big shot, drop, shot, drop. And the same thing's going to be probably going to be happening with this. The question is, where is it going to top out at? And I think this is a good top out point. I don't know if it's actually going to hit that. It could be where it is right now, and it continues to go down. It could go sideways for a while, too. I think sideways is actually extremely likely, but that's also kind of bullish because that shows you there's support that's not going down. And it really depends upon the market, the whole, how everything else goes. If the Fed comes out kind of dovish, oh, we're going to bounce, man. Like, if we're going to get a Santa Claus rally, it'll either be 1, after the Feds finish talking, or 2, after Christmas. Because sometimes after Christmas, like literally the next trading day, things go off. And the theory was always that, oh, that's where people get Christmas money. But it's like, what? You mean like hedge funds? They're getting Christmas money from their, I don't even know. But there's a rally after Christmas sometimes. And I don't know. I can't really explain why. Maybe that is right. Maybe it is just the cash coming into the market. But it's also the last little bit before the beginning of the next year, which I think is even more likely. Because people are looking at positioning themselves for the next cycle. And 2023 is coming up. 2022 is basically done. We have a month left, and we have 1 meeting left, but everything else has been said. This has been a really dramatic year. I mean, all of this stuff has been, I could look at this chart and tell you what was happening at any point in that time. Like, all these bounces were Fed meetings. We had a point where retail turned around a little bit. We had bad earnings. We have this point right here where everything was hitting the averages. It's starting to look a little bit more dovish in the long term, where before it was looking hawkish. They kept saying, oh, we don't know how high it's going to go. We don't know how high we're going to put rates. But now they're kind of like, 5%, maybe 7% at some crazy high estimate, which I don't think is, I don't know, it might go that high. But in the short term, it doesn't look like it's going to, as long as the data continues to be the same. If we get another low CPI and PCE and all that, then yeah, I can see everything looking a lot better. And of course, if we do, then the market will rally more. So the next set of the data points, the Fed meeting, the end of the year Santa Claus rally, that's what I'm kind of waiting for with all this. We're at a point where we could go up quite a bit because there's pressure. The first red day thing hasn't been working. If you did a first red day, here, you won. First red week, I should say week, because these are weekly candles. First red week here, you won. And then until you got down to here, now first red week, you lost. And it keeps going up. First red week, you lost. It keeps going up. So is this going to be another set of the first red week losing and going up? I don't know. I think there are a lot of reasons why it could go up. I don't necessarily think it will, because I don't actually predict anything. I know that there's no way you can know what will happen. You can just take a look at things and think, this might happen. So it would be good to prepare for this maybe a little bit more than other scenarios. So you don't only prepare for that. You just prepare for something a little bit more because you think it's a little bit more likely. That's what I'm working with here with this strategy. It's just trying to make sure that I get things in line with what I think is actually going to happen, which is cool. So we're at a low point. We're at a high probability for a tax loss selling year, which is great. I'd like to pick up some shares in the long term. My long portfolio has been growing throughout this time. I'm actually lower on cash now because I used a bunch of it to buy. And I did make a few good trades. So one of them I was talking about earlier was GPS. So I made a good like 20-30% on that, which was about what I lost in my free cash. So I came up to that point, and then I also bought FedEx. So let me go to FDX real quick. I bought that a while ago because I thought, man, this is heavily weighted to the markets. This is very necessary. If you look at the long-term trend with the standard deviation channels, it's up, up, up. The average point at which people are in this stock is so far below it, we haven't seen it in decades. So like this is a good stock to have. People are happy. The whole zone of massive share accumulation is below where we are right now. So like there's heavy volume. People are way up. Even if we lose a ton on this, people are still up. So this is a beautiful company. Plus, it's like, it may not be a beautiful company. Like, it's got its problems too. I'm not saying in that sense, but like in the overall sense, like you could have used UPS or whatever. It would be the same thing. Like it's heavily weighted to the indexes. It's an important business. It needs to be there. So it's good to have a stock that can move like that. This will move with the tide strongly. There are certain stocks that move better than other stocks. And the one right now, the leg that we're in right now shows that most people are up on this stock, and it's heavily weighted in the indexes, so it'll move higher if we do. So I bought some calls down here when it was really cheap, and they were up quite a bit, actually. So I didn't sell them because I do want to see if this goes a little bit higher, and if it goes lower, my risk isn't that much, and it doesn't drop that fast. That's what I like. My risk is down in the low hundreds, and when that stock drops, it doesn't go much below that. Like, it maybe goes into the double digits for a little bit. So the high double digits, it's not that much, So I'm good being in that section right there. And even though it's double that right now, actually, I think we were in the 200s, maybe in the high hundreds on Friday, so it was up quite a bit. That was kind of nice. So yeah, GPS, I made some on that. FDX, I made some of that. I also had some on the general market itself. I think the market direction it's got a possibility of going up. It could definitely go down. I would not be surprised if it went down. But I mean, we've got some pressure to the upside for the time being, right? Something like we had the CPI, and the CPI gave people enough hope for the upward trend to continue. Until something stops that trend, we're just going to continue to float up. So we haven't had anything stop it yet. We had a little bit of a drop on Friday. We have some scares, but how people react to that next week is what's important about that. So we could still be going to the upside. We could be going sideways for a while. I'm thinking it's not going to be, if we do drop, it may not be that crazy of a drop, because I think we are getting close to some point of support. This is FedEx. Let me get back to the actual market here. In fact, let's take a look at the futures. So we're kind of even with where we were. There's not much volume right now, so you can't tell anything. I mean, look at this. There's no candle here because there's so little volume. So the rest of these are the average volume. This is the average volume over time for the overall stock market. I guess you should say, or the E-minis, which is kind of like a representation of the overall stock market, not the market itself, but just a proxy for it. And we haven't even started. You can't even see the candle yet. So there's so much trading that has to happen. I have no idea which way this is going to go. I'm ready for it to go either way. I made some gains. I was buying down here. Like, that's what I was talking about. Never finished. I was buying on the way down, which hurt. Like, it's really going to hurt as a buyer to get in and to see the very next day that you could have bought it cheaper, that what you already bought was losing money. That's how you feel for most of the year. You have these pumps, you get excited, right? You don't buy as much on the pumps because you're like, I don't know if I want to buy it this high because it's going to go down, and it probably will. So you're actually smart about that. But you end up buying it here because you think, oh, it's been gone up quite a bit. Maybe I'm going to miss out. Nope, this is what I bought, right? That's not what I bought, but that's what happens when you're going after something like that. You always end up getting it up here when you resist it. So get it while it's consolidating, while it's down, and then when it starts to pop, you don't let it go, or you don't buy anymore. You just kind of dump it as it goes when you're in a market that's trending down. But when you're in a market that's trending up, you want to hold. I mean, even if you're getting at weird places, you don't really want to hold. It really depends. Right now, we've had it's more difficult to get money, so it's going to be harder for people to inflate things. So these loans that they took out to inflate things are also going to come due, and they're going to have less money to pay it. And some people, the loans are going to be more expensive because they have adjustable loans. Like, you think adjustable loans are a thing of the past? No. Adjustable loans are always there. They want adjustable loans because if they're getting screwed, they want to be able to change it. They want to be able to flip it the other way. Like, okay, I'll get screwed for a few months, but then once the rates go up, then I'm going to be, doing well on these. So it's like everything has a buyer and a seller, basically. Somebody to make the transaction and somebody to give the capital for the transaction. So we are the ones giving the capital and hoping that it works. And the people taking the capital, which are taking the risk, want something to do that. So they are trying to get paid as well. We got everybody trying to get paid. We got a downward market. We have a chance to pop a little bit, but we still have a down year. So I can see people selling and selling hard to get in before, number one, new tax regulations come in. Number two, they have to do their new positioning for the year. Number three, whatever they think is going to happen with the market happens. There's just so much to take into account. I can talk all day. I'm confusing. I ramble. There's so much to say. It's hard to get it all out, but I'm doing my best. Right, this has been a crazy week. I mean, we had like the CEO of Tyson, where he got arrested for entering someone's house and falling asleep on their bed or something like that. Like, the guy was hammered, and he was supposed to give his first speech as the CFO a week or 2 weeks after that, and he did. But still, it's just like that's what's going on right now. Things are so crazy. There's so much to do, and people are thinking about partying and going crazy instead of actually working on their stock. Like, if you take a few minutes to just fix the stock, maybe you don't have to party so crazy that you pass out or whatever. So yeah, that dude passed out on her couch, and then now he got picked up. He was into jail for a little while, and it's just crazy. It's crazy. So there's also Tesla. It's like, what's going on with Elon Musk because of the whole Twitter thing? Is he going to be selling shares in Tesla? In fact, let's take a look at Tesla and see how that's doing right now, because that's one that is talked about a lot. And even the fact that Twitter is gone, it's still being talked about. I love how it's not even on the market anymore, and it's taking up more of the news space than it was when it was here. It's annoying. But we have Tesla way down. I own some Tesla. I started buying somewhere, I think in this mess right here. Like, after it had gone down quite a bit, it was starting to stabilize. I remember these huge drops right here. I thought this was a great place to get in because I was up for quite a while, and then I've only recently gone below where my average is, which is nice because now I get to finally buy some more. I always like to buy when it's down. I do buy when it's up, but I just don't buy in as big of quantities. So I've wanted to buy some seriously large quantities of things and haven't been able to do it for a long time. So now that I finally have a chance, I'm not buying them in huge quantities. I'm nibbling a little bit over time. So that's how you diffuse the pain of being a buyer in a buyer's market. Because yeah, you buy it here and then it's down the next day. It's down the next day. Oh, next week's red too. Oh, next week's red too. That's hard to deal with. So if you keep buying, your average drops. And when things bounce, you make more money. Because your average is the point at which you start making money. If your average is somewhere in here, eventually, if it passes this point of high volume, you have a chance to make quite a bit. Because here's the old high, right? And this is Tesla. I mean, who knows with any individual stock. But in general, when things are down, that's when you get to buy. So I have a little bit of Tesla. It's been nice to buy it, even though it's finally red. There's the whole thing about Twitter. I don't have enough Tesla to really matter if they actually really dump it hard. I wish I had more of Tesla, but I just have so many things I want to do. And by the time I bought some Tesla, I was already down a bunch on my cash because I'd been buying other things. So I don't know. It's an expensive stock, so I don't have enough to really buy. I think my money can be deployed better in other areas to make more than buying Tesla stock. So that's what you have to think about. It's like, how much money do you have and where can it be deployed more effectively? That's why I'm in options, because the amount of money I have works best with options instead of shares. So it's enough to actually move, but my risk is low enough and I have enough capital to actually make these plays. Because that's key. Like when you have options, yeah, you can trade options with like $20, but you're not going to be able to get much. You're probably just going to lose all the time because all you can afford are these contracts that are definitely, and when I say definitely, I mean like 99% definitely. So not definitely, but definitely you're going to lose. And you're gonna, that $20 is gonna go away. But if you have more than that, if you have a few $1,000s, if you have like $10,000, $20,000, you can actually start doing some stuff. Like even just a few thousand is all you need with options to actually make a decent strategy. But the learning curve is rough with options too, so you have to be ready for that. That's when I'd definitely say paper trade before you get into. But if you find if you can buy shares, that's the way to go because shares don't have a time limit. Like options have a time limit. I like options because you can use less capital to make more money, but they have a time limit. They have so many, there's so many strings attached with options because there's like how much it makes, where it depending upon how much the stock moves, but also that also it's subject to the buyers and sellers. So it should be around this much, but ultimately it comes down to whoever is going to sell it to you at whatever price. Hey, what's up, Salome Fishby? You don't like Tesla because they look like Transformers. They tried to sell after they killed off all the ones from your childhood in the movie. Okay, I get it. So they hurt you deeply in real life, so you hate Tesla. I get it. That's how people run right now. Like everybody hates everything. So there's something they don't like. Elon Musk is a perfect example. Remember a few years ago, like everybody loved this guy because he was saving the earth, and now he's like literally the most hated guy. I mean, Trump's kind of gone, so now it's like Elon Musk is the new Trump, kind of. It's the only difference is like he's successful, whereas Trump. I mean, because you can say he made it to president or whatever, but like Elon Musk has done a lot more than Trump did in the amount of time that he's been here, right? He's had more of an impact on the world, more positive one with like a lot of the businesses, but also a lot of negative too. Like people, it's not just all good. Like the guy recently, it comes out like. This is not the dude that you thought he was. This is like, he's an actual person. He's not some like deity. Because everybody's putting him out to be like some deity back in the day. It's like, I was cool with Elon Musk. I liked what he was doing. I didn't, before all the political stuff came out, just like everybody else. And I still don't mind him. He doesn't bug me, but there are people that really, really hate him. Or people that really, really love him. And there's a perfect point for the day, right? I was thinking about this yesterday. And the reason I said earlier that what I look for is the thing that people, number one, don't want to happen, and number two, don't think will happen at the same time. I look to that because that's the thing that shocks people enough to make the moves that you can profit on. So if you look for those things, you might be able to ride with them because they happen all the time. When people don't want something to happen, when they resist something so hard, they give it the fuel to actually start. Like everything in the universe seems to have like a part and a counterpart. And if you resist it, you're the counterpart to that part. You're making it happen. You're giving it the fuel to do the things you hate. And that's what people don't understand about reality. That's what you're doing with your attention. That's what you're doing with everything that you actually have. You're putting the energy into something to make it exist. Whether it's good energy or bad energy, you're just one side of the piece or the other. So if you hate something so extremely, you're pulling on it in a sense that it allows it to function in the way it is. You're holding it there. You're using your resources to make sure that it functions. You can't hate stuff. You can't get caught up in stuff like that. You have to actually just build something and concentrate on what you're doing. So you're not adding that energy to the thing you hate. You're not giving it a reason to exist. Because when people are frustrated, they always want to find the contrarian. You know, if you lose a lot, eventually you want somebody that wants to buck the system. So you're going to look to somebody that looks like they're destructive and are dangerous, but they're still around and they still have some kind of success. So you can say, haha, they can say whatever, but there's that. Hey, what's going on? I'm just hopeless. Good to have you here. I'm going on a rant right now. That's what happens here. I go on these rants and I forget what I'm doing. So I kind of did that with that. Oh no, I didn't. I remember what it was. So the point is, if you add energy to something, if you add too much energy to something, you might end up just giving it a platform to exist. So if you try to calm down and look into something else, that thing will run out of the foundation of the thing. The platform of the thing will crumble because it won't have enough attention to keep going. So people are hating everything, and they're saying, because they don't want it to happen, that it won't. They're not saying it won't happen because they believe it, because the data says it. They're saying it because they don't want it to happen. They're basing their opinion on emotion, which is the reason why those kind of things end up happening. The most unlikely and the most unwanted thing ends up happening because so many people resisted it and didn't want to look at the facts behind it. Like, that's how something like Trump happens in the first place. The frustration of people got that dude elected. And whether it's him or not, the same thing can happen again in either direction. You can get a left, a right, center, whatever. You can get a crazy person to just come in and wreck stuff. But they don't usually end up actually wrecking stuff. That was the thing. Everybody thought the world was going to be over when Trump was president. Well, guess what? We're here. We didn't die. We did fine. I mean, there was the pandemic, but like every president before that was the same way. People thought the world was going to be over because of like Obama and Bush and Clinton and blah, 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 blah. But we end up higher. Look at where the market is now. If we go back to, I'm going to go to the SPY, right? That's going back to when Clinton was president, basically. Look at it went sideways for a while, but look at where we are. Even though we've come down, like this was the peak at the beginning of the year, we've come down a little bit, but look at where we were in the 90s, right? We're here in the 90s, and through the 2000s, people saw this sideways action, and when they were down here, they'd seen this go on for so long, they thought everything was over. But look what happened there. We turned we turned the money spigot on and never turned off. And here we turned up the intensity of the money spigot, which is why we finally have to back it down. And instead of backing it down in a way that shocks everything, because this was an outside shock, but trying to do an inside shock because of inflation would just cripple the economy if we did that incorrectly. So trying to do it over the short term is the way to go. And that's what they've been doing with these rates. And that's kind of why we're seeing a gradual decrease in the price. So where is the settling point of all this stuff? That's the question. Like, the reason the market moves down is because companies are pricing in earnings at a certain rate. The cumulative amount of those earnings is what the market prices itself at. If everybody's earning around this range, then we'll pay for something around that range in a stock like this, in an ETF that has like basic market exposure. The SPY is supposed to be kind of just a proxy to the S&P 500 that you can buy as a stock easily if you're just a regular stock trader. So you don't have to go into other markets like the futures market, the options market, and all this to trade that thing. You can just trade this with a little bit of money, and on things like Robinhood, Webull, and all these platforms now, you can buy fractions of these shares. So there's ways for people to go long here that didn't exist before. We had more money come in to pump everything up. We have strong fundamentals, and things are starting to finally weaken. So all the naysayers that have been wrong most of this time, because they keep saying like, oh, earnings are going to be different, earnings are going to be worse, and earnings aren't worse. Like, the market goes down because the projections go down, but earnings don't underperform. Each time the earnings look decent. Like, even though they're not perfect, even though they are trending in a direction, they're not going down as much as people thought. And the ones that are going up are not going up as fast as people thought they might. We're getting a more reasonable movement. So I think we're settling into a zone at which things are a little bit more fair. I mean, we've come up so high since that point, we needed a way to kind of consolidate. And halfway in between here and here is about where we are now. Actually, we're above halfway at this point. But just in that range, I think is very reasonable for the stock to stay for a while. And we could go a little bit lower, but keep in mind, the lower we go, the harder it's going to be to get down there, because the more pressure there's going to be from the large amount of volume that exists at those price levels. Like, when you start getting into this stuff, where the people that are still up are, that's when you're going to get a lot of craziness, but that's when you're going to get a lot of volume. So I think seeing it bounce around in this area is quite likely. Like, eventually I do think we'll continue to go up, because even if it's a long drawn out trend, or it's a shot, there's just reasons for it to go up in the long term as opposed to go down. In the short term, there's reasons for it to go down. And I do believe we not will, but there's a good chance that we could see a correction down to these levels because people are going to have to react to what actually happens now that we've reacted to the predictions of those things. So what do you, wow, it's fun to listen to you rant. Followed. Hey, thanks. I appreciate that. That's what I do. I basically spill out my guts on the market because in real life people are tired of hearing me talk about it, and all I want to do is just let this stuff off my chest. It's what I think about all the time. It's what I love to do. So it's nice to come here and just rant and have people come in and listen. So where was I on this? All right, so we're in the middle area. Let me check my notes because I got to start winding things down. I think I've been rambling for. We're getting? Oh yeah, 4:30. I got to start kind of winding. So we talked about FTX a little bit. Basically, they made a fake token. They borrowed against a fake token, and what do you know? They had $8 billion worth of missing money in there because they were like, oh yeah, there's only 3 billion of these tokens, but we said we had 8 billion worth. So what do you do about that? You go on bankruptcy or you file bankruptcy because it's over at that point. So we talked about that, that whole thing. Here's the thing. Now I'm going to rant a little bit about this part because I never liked that Sam Bankman-Fried guy. That dude just always seemed off. Like the way they were operating their business was what really got me. Like when the crypto market started to go down, because it's following the overall market now. So these companies that were getting in here and are reliant on the money or the market continuing to go up are hurting because they were borrowing to make all this stuff go. When stuff goes up for a long period of time, because keep in mind, each one of these little candles is a week. So this is a very long time to see the market go up. That has an effect on your psyche. People are more willing to get into risky bets the higher it goes, especially at these points where they really shoot up. People are they think they're missing out. So they're getting in, they're borrowing money. They don't care. They know it goes up. So they don't care about the type of loan that they get. And what comes back to bite them is when rates move and they find out their loan's adjustable, or they knew it was adjustable, but they were just hoping they'd make enough in whatever amount of time. People at this point in time had no idea this would be next year. They thought this was just going to keep going. Like the next 20 years was just going to be all that. Like when you get to this point of a rally, when like the last wave of the masses are coming in, people think it's just going to keep going. And it probably would. Actually, this would have continued to go if they hadn't changed things right here. That's why you get this like razor cut off top, because at this point they announced, hey, the free money spigot's going to be turned off. We're not turning it out. I should say turned down. We're not turning it down yet, but we're warning you that it's going to be. So people think, oh crap, that means rates are going to move. That means my adjustable rate's going to come due. So I need to get out of this thing quick. I can't be into this upward movement anymore because it's unlikely. It's unlikely that it's going to happen. So they'll get out right here, they'll change hands, and everything starts to fall. Well, then we get the Fed come in and say, all right, here's what we're going to do. We have this plan to tighten rates, and you knew it was coming, so get ready for it. Squeeze everything, market goes down. We find a place that's maybe closer to a fair value, probably lower than that. I'm thinking in this level, when we start getting to these high volume, moving areas right here, like huge movement areas, that's where we start to see some support or maybe just below those areas. If it goes down, I can also see, I think it's more likely to either go sideways or bounce for a while. If we're talking about new highs, I don't know, maybe in the next year or two, I can see that happening. Like next year is likely if things continue the way they are. We don't have new upsets because new upsets are going to be a problem. That's right now we have pressure to the upside. We had the CPI come out, and basically the main thing that was driving this was inflation. There's all different types of inflation. There are so many other problems in the economy, but inflation was the number one focus. So the people that didn't know anything about finance were focused on inflation. They weren't focused on mortgage-backed securities and CDOs and stuff like that. They were looking at, is it more expensive for me to go to the store and buy things? And that's what the stock market responded to. It responded to the fact that there was actual fundamental reason to change. That's why we have this drop. We had this fear bring it in, and we're not going to pop above that until everybody is repositioned to where they feel comfortable. The people that made money and are still up are trying to take some gains because they're worried about it. And the people that have been waiting to get in, like me, are buying the dips, are getting crushed and loving every second of it because it means they get to buy more at cheaper prices. I really do. Like back when I first started trading, I said I wanted it to go down, but it hurt too much and I didn't. Now, I actually really like it. When I buy something I believe in and the whole market goes down and that thing I believe in goes down a little bit, but not as much, that is like the best feeling in the world. Because you go, listen, this is a good stock in the future. If it has support now, it will have explosive power in the future. Like things that aren't really worth anything and they're just an image, those get found out at some point. But when things fall and you find out that these companies have value, all the investors in these other things flock to those to those older investments that were smart to begin with. That's why I try to have that stuff now, so when everybody comes in and lifts the tide for me even more. I want to be in when everybody else hates it, and everybody hates it right now. especially crypto. People think it's over. Like this FTX thing, there's a blow off top for the upward direction. We'll say whatever, the same thing in the bottom, a blow off bottom. I don't know. Somebody said that the other day and people were laughing. And I was like, I don't know. Is that something? And maybe. But at this point, yeah, there's like, in my opinion, we're starting to get that quote blow off top for the bottom part of it. It's going down because of this. It could go down more because there's a lot of debt that needs to be paid. There are a lot of companies that are going insolvent because they had a piece of FTX. There are a lot of celebrities too. There's like Tom Brady and Shaq and Steph Curry. And then here's a great part of that. So a lot of these influencers, right? If you go on YouTube and you try to learn finance, any of the top influencers probably had some kind of FTX sponsorship. Like some of the other people that looked into it were smart enough not to get it because here's the thing: they were offering like 8% a return on their investments. So how do you, or more than that? There's like 8% or more. So how are you getting 8% when the overall market is way under that? And they won't disclose it. They wouldn't say how they were doing it. You know why they wouldn't say? Because they were taking your money and they were loaning it out to risky investments because they have to make money too. If you're making 8%, they have to make more than 8% to make that worth it. So whatever you're making, I guarantee you they're making a lot more than that. Even if it's just shaving a little bit off the top, if you do that on a grand scale, that ends up being a lot of money. In some way, they're profiting heavily off of that movement. So what do we have down here? Life of Ronan, stocks the GOAT. Hey, I'm trying to be the GOAT. I'm not there yet, man. I'm the intermediate. So I like to say I'm an intermediate trader. I only know enough to get myself in trouble, right? That's what I'm doing right now. I'm just getting myself in trouble all the time. I'm doing well, and then I'm not doing well, and I'm feeling bad. But hey, you know what? This year I'm up. This is so much better. Last year I was my worst year ever. I lost so much. I say this every broadcast. I'm sure I know that, but I'm making a point about it. Like it's the way you think about your trading, the way you conduct yourself as a trader really matters. I still have a lot of the same problems I had when I was losing more last year, but I've been able to curb those through different practices, through better habits, through making sure that I like for number one, I don't trade the open anymore unless I absolutely have to. Like sometimes you just have to get rid of something right away, or you're planning on making a move in the morning. Yeah, that's fine. But for the most part, when I don't think about trying to catch those pops in the morning because it's very difficult to do, and if it goes the wrong way, that can really hurt. So I just ignore that because the morning isn't the actual movement of the day. You have to see the high volume come in, and then what happens after that? Does it settle in that range? Does it move up? Does it continue to go down? What is it doing? That will tell you after the craziness has happened what you can do. Because a lot of times the craziness happens and then it hits a low right in the middle of the day, or maybe towards the latter half of the day, but still somewhat in the middle. That's where a low tends to be. And since I'm more of a long trader, I don't buy for the short term very often. I do sometimes, but most of the time I'm thinking about the long term. So I like those low of days. I like to get those. If I'm swing trading something for a couple of weeks, that's a great time to buy, especially when everybody hates the market and everything's going down. Getting it on like a Wednesday or Thursday on a bad market week. Oh, I love that. That's one of my favorite trades right there. Snag that stuff and hold on to it just for a little bit, because as soon as there's a people are like they get mad, they get upset, and they're like, I'm done, I'm leaving it. And then a day later, they're like, wait, no, take me back. That's what it's like, natural behavior. And people do that with stocks. It's not just in relationships or anything else like that. It's with how your interaction to your addictions and to your habits and to the things that you do. Like it's that give it like that quick switch from one side to the other. I'm having a loss of words right here, but just the fact that you move so quickly in both directions causes the market to move because there's extra force put into moving that fast. Like to get those prices, you have to get in there quickly because a lot of people are trading it. So people are putting in much lower limit orders or much higher limit orders than they normally would if they're doing limit orders, because you don't want to do market orders in an environment like that. I don't like to do market orders anyway. I mean, I do them like when I'm buying stock and there's 1 million shares on the buy, 1 million shares on the ask, and they're a penny apart. Then yeah, I'll buy a few shares on it. If I'm just buying a few shares, like I'm not gonna do a big order. I'm definitely putting a limit order. But if I'm just gonna buy like a few shares here and there or whatever because the market's in a nice down day, yeah, I'll throw a market order with a nice tight spread like that. That's fine. But most of the time, I want to have a limit order going so that I don't get screwed, because I've done that. There were times where like back in the early days of my trading career, I used to be mad at limit orders, because I never got them. It would always go past them. I didn't know how to set them. Like you have to set it with a cushion to where you think the price is right now if it's moving quickly. So that means like you want to get a stock at 10, you have to be willing to get it at 11 too. You know, like if it's going to drop quickly beyond that point, like you want to set the thing to get it as with as much cushion as you can reasonably. Because if you set it with too much, then you can get in on something really in a really bad position. So just setting a limit order with enough to catch it is the way to do it in those environments. But most of the time, I just like to get what I can and buy for the future because right now everybody's looking at the downward movement, which is coming. If it's not over yet, it's probably going to be over soon, assuming nothing new. So if you don't quote me, like new shit happens, yeah, I know the market could drop very easily. That's part of it. But if nothing new happens, if just little stuff happens, then we have pressure to the upside. We have a chance to continue to go up for a little while. Until that changes, I'm going to invest and trade in that manner. And right now, to me, it's like I have a hedge for the downside. So that's kind of like my thought right now. I'm weighted more heavily to the upside, but I do have some exposure to the downside just in case because I want to make sure I'm protected. Like I don't want to put so much into downward exposure that if we don't go, I get screwed. Because when it comes up like this and the shorts are down, like I was saying before, there's temptation to do that. There's temptation to buy heavier to move your position to the next level and say like, hey, if this goes in my favor, I'm going to make a lot of money. But if it doesn't, you're going to have a problem. So right now, the shorts they're sweating. I mean, they've been adding and all this, and some of them are out. The bulls are happy. They've been buying. We had a little red week. So far, the first red day short thing hasn't been working. Is it going to happen this week? I don't know. Maybe. We're waiting for the Fed meeting. That's going to tell us what's up. I know I keep saying the same stuff over and over, but I get distracted easily and I go on these tangents. So back to my paper. Let me get through this paper that was poorly printed. I was late to the stream because this thing wasn't printing, and then it printed terribly. It didn't print anything like the preview. So it was, I needed more time, but I was rocking out to a bunch of music, so I kind of wasted some time right beforehand. But I still got it done. I'm still here. I'm still rambling. So we talked about some of my trades, right? I did SPXU. That was the other one. I basically weighted that to the upside, a little bit to the downside. I took profits on that the next day, and then I had some left, and I closed the entire. Well, I kept the short leg because it was pretty much worthless. So if you have options that are worthless, you might as well keep them. I mean, why try to sell them for $1 and then find out later that it actually goes in your favor and those things were worth hundreds of dollars or something like that? So hold them till they're dead. So I'm holding those, but my in the money options have been liquidated at this point. So that made me back all my cash from that loss and then some. And then there was GPS. So the gap trade, that'd be a decent amount. And then I still have some other longs like FedEx. I'm still holding on to a FedEx leap. So that'll be worth a good amount of money if we continue this trend. And if we do go down, it's going to go down a decent amount, but it's not going to be completely worthless. And I paid it. My risk on that is decent. Like I don't like it as much as I like some of my other ones because it's a little bit higher risk, but it's still within the threshold of what I consider to be acceptable. And it's got a lot of protection from down. Like even if the stock goes down, it doesn't move all that much because delta's lower, but its theta is also extremely low. So anyway, I'm rambling. Let's get back to it. So I wanted to talk about a couple of things. Number one, Walmart and Target. So Walmart did well. Target did not. Why was that? That's actually an important distinction because the difference between those two stores is kind of the amount of food that they have, right? Like there are definitely other differences, but Walmart gets about like half of it, maybe over half of its profits from food. And food was doing well. But things like apparel weren't doing as well. And then other discretionary items, like all the other random shit that's around the store, that wasn't doing very well either. And Target has way more exposure to that and way less exposure to food. So they got hit pretty hard. They had to guide down. I mean, in order to add more food, they have to expend so much cost that it wouldn't be worth it to go crazy. So they have been adding more food. Like, I don't think they used to have food at all or very little. And now they have like a whole produce section and stuff like that. That's been in play for a few years now, at least. So they're moving in that direction for sure. But Walmart has way more exposure to it. They were allocated way better for this environment. So they didn't have to mess with their projections in the way that Target did. Target, which has been disappointing like crazy already, it has a huge amount of inventory. It doesn't have exposure to the things people want. It's not looking good, which is why I absolutely love Target in the long term. I'm not going to touch it yet. Like this is still probably a falling knife as long as, it's been bouncing a little bit. TGT, come on, give me some Target. Where's my Target? Zoom in on that Target. Yeah, we had this. Oh, could have made so much money. I know I say that every time. Right here, this drop, I was looking at buying puts and I didn't. And I could have bought. I could have just had one put. It would have been a good amount of money to make on this. That's how crazy this was. I'm always kicking myself. I could have bought one cheap put. It didn't. Anyway, so it's been down in this range and now it's kind of towards the bottom of it because of this whole thing. Reported, not happy, but it didn't crash through. I'm not surprised. I mean, Target's getting hit. So if we continue to go down, Target will be one that'll get liquidated. Like this actually would be a good tax loss selling candidate. Thinking of that, like if you want a good quality stock, like not a penny stock that is decent for a tax loss selling pickup, this is one because it's in the indexes. It's highly weighted. It's nowhere near as big. I think it's like Walmart is like 4 times the size of Target or something like that. But it's still a massive company and it's still following the indexes and it's still doing everything else that the rest of the market's doing. Because even if Target has problems, the weight of everything else will move it quite a bit. So looking at that, I mean, penny stocks don't have that. You know, like if you want to go finding some penny stock, yeah, you could find something that can go to the moon, but the chances of that are so not in your favor that it's not worth it. It's better to have something that has a good opportunity to move up, and it does. I mean, the moving averages are pulling down. It's got a huge amount of volume for what happened this week, which isn't a surprise. You can see right here, like the big volume days are these big drops. Like this drop right here had a massive amount of volume because it was one of the biggest drops it's ever had. I liked it after that, but it's been bouncing ever since then. And even with this, it still didn't go down too far. I think it has some more downward movement, but if it comes down to the low side of this range, or even though it's kind of trending up, so this could be the low side of the range. I don't know. It's something I like for the future. If we have a huge panic, that'll Target will be one that I'll be looking at for leaps for sure. So I like that one in the long term, but in the short term, this is going to be massacred, so it's going to be a rough one to buy. But with something like this, it's nice to be able to look at it and say, hey, it would be good in an uptrend. I could see it pumping in an uptrend. So Target, I like that. Walmart, I like it too, but it's up, so I don't like buying it right now. Walmart, it's been in a range for quite a while. In fact, it's been in a range for so long that I like it as a trade for here. See, this is the Target thing was also affecting other companies. Like it was because they had too much inventory. That's what this drop was. This was like, yeah, sorry, we have all this stuff we can't sell, and not only can we not sell it, but it's costing us money to have it. That dropped everything. You know, Walmart came back. Look at where Walmart is now. I mean, it's back close to its highs. It's up where it would normally change directions. You know, this was kind of a fluke in the at the time. I remember I used to see Walmart come up to like the 140s, 150s, and then it would drop down, and that would be a good buying opportunity when it was in like the low 130s or something like that. And it just did that for a while, and it trended down lower and lower until we got this massive pop. So I've always liked to have it do bad on earnings and then short it a few days later because it would bounce so well. It was one of the better stocks to do that on. And the fact that it's doing this in the long term too, I mean, that shows you it's got support. You know, right now is not a time to get in long on it, or I wouldn't short it either. But I like the fact that this is telling you that the retail environment isn't as bad as people think. Like it just depends upon what you have exposure to. Target had exposure to all the worst stuff. I almost call it McDonald's. Walmart had exposure to the right amount of stuff. I mean, they still had some problems. They still were exposed to things that didn't sell, but they had the things that were actually profitable to carry them through that. And they've spent so much on R&D that they have all these different ways to make money now compared to years ago. So they're they're a huge stock. They're one of the biggest stocks on the market, and they do well. So I'm not surprised that they're going to bounce all over the place. This is what I like. I like shorting because it doesn't drop as much as the other ones do. And when it does, it tends to bounce. Like, look at what happened after this. I mean, this was a huge shock because this candle happened in one day. There was a little bit more movement after that, but like most of this movement is 1 day's worth of movement. So that was really shocking to the entire sector. But it was a good buying opportunity because when you push it down this far after having so much support up here, people are going to buy. Like the people that have been buying it in all this right here and right here are going, hey, I've never been down before. I need to buy. It's finally down below my average. And now if you did, it was a good move because you're above your average again. Pretty much everybody's up. We're at a point where very few people are underwater on Walmart. So that tells you there's some strength in the retail environment, right? So one of the other things that happened that was kind of crazy was there's doubt as to how much people have in savings now. It's with the increase in debt, like credit card debt and other kinds of debt, it's showing you that maybe the savings reserves that people thought were still there aren't there anymore. So that could be one fundamental thing that actually shows you that the economy is struggling more than we would normally think. In that case, I think it's kind of true. I think we are starting to slow down a little bit, and I think projections are going to have to reflect that at some point. I do think we have bounces and all kinds of other stuff, but right now, I think we're going to have a little bit of a rally until we come to our senses, until reality sets in, and we have to actually price for what's going to happen as opposed to pricing for the joy of not having to deal with pain. That's a good way to put this. Like, these bounces right here are just people's relief that they don't have to deal with stress anymore. But at some point they realize, oh, we do have to deal with stress. But in this little section right here, when you're going up, I mean, it's a good feeling, and they're not thinking about it. Not until they realize, like, wow, we are way above what the price is for these projections. Like, like I said earlier, if you combine all of the earnings projections into one thing, you get a price level at which the market could sit theoretically. And that's what a lot of these companies are doing. They're trying to figure out what that price is, and they're also kind of making that a self-fulfilling prophecy by buying and selling to match those levels, to match those predictions. And right now we're at a point where those people are in this range where a lot of the trading has been going on, but at a point where movement can happen severely in either direction. So I'm excited. I don't know which way it's going to go. I assume a little bit more up before some down, but you never know. Could be a bunch of up, could be sideways, could be down. You really never know, and you want to be ready for each. So I have long positions if we go up. I have some short hedges if we go down, and I'm not overextended if we go sideways. I have time if we go sideways, and I'll also be buying if we go sideways, because like any more money I can add to it, I'm going to be buying on those dips as well. I'll be increasing the trading account, and then I'll also be buying any of my long positions to add to over time. Because everything's underwater right now, so it's been like my dividend stocks. This has been wonderful. But here's the part that I love about some of this. All right, so I have Verizon as one of my stocks. It's one of my biggest holdings, and it's a dividend stock. It gives you about 60 something cents a share, maybe a little more than that now. Like, I don't remember the exact amount, but it's giving you basically around one share's value per 100 shares you buy. So if a little while ago, so let's say a year ago, if you bought Verizon at like, 50, $60, you bought 100 shares of it, you had enough for the dividend to buy one share, and you could just let it go for the rest of time and it would compound on its own. But adding to it is that the plan is to continue to add to it with me. But if you just did that, that would be enough to get something going that makes money for you that you don't have to do anything with. Like, you could go buy a sandwich, or you could go buy, whatever gaming console, or you could put that money into something that grows over time and gives you more. It doesn't just go away. Like, I mean, you might use the gaming console to stream and make money or something like that. Playing game competitions, yes. But for the most part, if you're spending money, you're going to buy something you're not going to use that much. You go to a store, you think it's cool, you come home and like, I don't like it. You order some weird stuff online, it's too expensive to send it back, so you just keep it. There's all that kind of stuff. And then there's the stuff that makes you money. So the point was, I bought Verizon in the 50s and 60s. I think my average was in the low 50s. And now it's down in the 30s. But it's still giving you the same dividend. So I was paying double for the same amount of dividend. So basically now, that dividend per 100 shares gives me 2 shares each payout. So I'm getting double the amount of shares, which means it can compound faster. It can grow faster for a cheaper price, or for the same price, I should say. And if I just want to buy one share, I'm paying half of what I was, but I'm getting the same dividend. That is wonderful, because the dividend pays consistently. You think like, oh man, the stock only pays once a quarter, which means once every 3 months. You get 4 payments a year. That's really not that much. Well, over time, you realize it is, because time goes on. It doesn't just stop. We kind of like think about certain points in the future, and that's about it. We don't really think about how that's just another piece of it, and it's going to flow through that point. But dividend stocks prove to you that over time, you forget about that dividend. It's not that much. Oh, I only have so many shares, and the dividend, it doesn't even give me a share yet, or it only buys me a share or two. Well, that's fine. But month after month after month, you log into your account, and you look at, oh, notification. Oh, I got free money in my account now. Right? Because I don't have any of them actually set up to automatically, the DRIP system, basically, the dividend reinvestment program. I don't have that set up on any of them. I buy it manually. But it's just nice to come to open my account and be like, oh, look, there's an extra like so many bucks. There's an extra $50. There's an extra $100. I didn't even think about that. That's really awesome. It's nice to see that. So I have a portfolio set up to do that, and right now I'm loving the drop on those because I'm getting the same amount from good quality dividend stocks. They're stocks that don't have to cut their dividend. Like Verizon, yes, it doesn't grow that much. If we look at the chart of Verizon, you can see like, why would you want to own Verizon? It doesn't ever do anything. Well, Verizon is paying you to not do anything, right? And look at that. It's been going, this is years worth of time. So here's 1996 back here. There was a huge pump in Verizon, and then it kind of fell with the dot-com stuff, and it sort of traded sideways until after the Great Recession, and it pumped up into this range. But it's been in this range since 2012. So it kind of hit this median, and it was following along this. So there is growth. I mean, if you look at the standard deviation channels, it's going upward. So you can see that there is some growth there. But getting it in this range was nice because they were upping the dividend the whole time. Every single year it was higher, 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 which is good because they could do that. They're a company that's necessary. They're they're they, they're one of the most necessary companies on the market. They're so necessary nobody thinks about them. That's how you know a company is successful. If it's just there and it's a part of life, and it's such a part of life you don't even need to think about it, it's a good company for the market. And that's what Verizon is. It's something you I mean, if you're paying bills to them, yeah, you think about them, but you don't think about the fact that you get on the internet and all that stuff happens. Well, Verizon's making that happen through a variety of things, and it's way cheaper. Most people are in here at this $46 amount. This green line right here shows you where most of the people that own the stock are in. That's why I like to look at this, because it tells you what the main sentiment is. So most people are underwater with Verizon stock. Some people bought in down here and they're still in, but most people are underwater right now because this is the median point. And this was the channel that it was in for the longest time. So it makes sense that this is the median point. And suddenly it's the same Verizon, but we're half the price. That's the other thing I was thinking about is like, it's the same stock. It has the same prospects. Yes, there's some problems with money. I mean, that happens all the time with every single stock in the market. Everybody's having a problem with money. But they're no different. It's because everything's down. That's why everybody's having a problem with money. So the fact that it's doing what everyone else is doing tells me there's not other fundamental risks to its own growth prospects in the future. So I'm just buying this one as much as I can. That's another reason why I don't have any cash, because I was doing that. And then there's some other stocks that I was looking at, like all the stocks that people are hating on, Meta and Amazon. Oh man, I've been buying those. Those have been some of my favorite buys right now, especially Meta. I had this rant last time about how Meta is Nickelback because it just keeps going even though nobody likes it. But that's how you know you have a good stock. If you hate something viscerally because it's different than what you're doing, but you're somewhat jealous of it, you're somewhat afraid of it because it looks like it's a superior product, and you don't want it to be a superior product. You want your way to be the way that it continues to be. So internally, you kind of have this fight with yourself. And if you're not paying attention to both sides of that struggle, you may not be able to see reality as well. Because if you're looking at something that's going to continue for a while and it's being hated on and it's way underpriced, that's a chance to get in on it. Even though it's probably going to go lower, even though everybody hates it, it's not cool, right? Well, actually, it's had a little bit of a pump, and because I was looking at the clip and I was talking about it when it was literally at its low. It was down here right after earnings. There was like this week or two. It was the last stream. I was saying, oh man, I bought so much of it here. And it's been up ever since. Like I started buying in here, but I bought enough to where I lowered my average to a point where I'm up already. I mean, this could come down, but I could easily see this moving higher because this stock is a powerhouse. When the market moves up, like look at how steadily this thing moved. You don't see that kind of steadiness in a stock very often at all. Yes, it got way more volatile, but look at the points at which it turned, right? Half a standard deviation, at the mean, almost a full standard deviation, right about a full standard deviation, back to a half. Like it turns around close to these points. Yeah, they're not perfectly touching, but they're around those points. I mean, because this stock is being looked at by huge firms that are using stuff like this in a way more advanced way. I'm just using it in a caveman way to be like, stock go down, stock might go up. But I'm doing it with at least some fundamental reason behind that. Because you got to have that lizard brain part that says stock go down, stock go up, but you also have to have a reason why that's the case. You can't just look at it and think that's the case because it's a stock that exists. I mean, that's 2021 strategy. If it exists, it goes up. Not always, but that when that happens, you can just buy whatever and think you're a genius. But with stuff like this, there's actually fundamental value. And look at how far it's come down from its highs. That's what I love about this. It's still Facebook. It's still Oculus. It's still WhatsApp. It's still blah, 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 blah. Instagram, you name it. It's the same company, but it's been absolutely decimated. So I love the fact that I can get in on this thing at a low point. Maybe if it goes lower, I'd love to add some more. Yeah, it's a good stock. I've been buying that one. Same with Amazon. Amazon was, it hasn't really pumped quite as much, but it's still... With the market, it's done its little move like everything else. So that one I'm still working on. I think my average is I'm still a little bit underwater on my average because I started buying it in here and I haven't really stepped up to buying. I've just kind of been buying a little bit as it's been down in this area, but I moved it down a little bit, which is nice. And I still don't own that much. I'd really like to own a lot more because Amazon, like if you think about a company that you can hate but is going to be strong, Amazon is that company. Everybody hates Amazon, but everybody loves it because they're all ordering from it all the time, telling everybody how much they hate it and how stupid Amazon is, meanwhile spending like 40% of their time browsing Amazon and buying things from it. So a stock that you hate, that is useful, that like you feel it viscerally. Oh, Amazon's a stock like that. Meta's a stock like that. Tesla is a stock like that. People hate Elon Musk. They crazy with the Twitter drama. You know, like here's all right. Here's my little take on the Twitter drama. It's too early to tell. End of story. Right? People that are saying it's going to fail, it's going to be this, it's going to be that. He is just starting there. This new cycle is just starting. We have no idea what's going to happen with this. Right? It's probably going to go back to almost exactly what it was at some point because they're going to find out, like, oh, they did this stuff for a reason. But it's probably going to be a little different too because there's a different perspective behind it. So it's too early to tell what's going to happen with all that stuff. I don't worry about, political leanings or opinions or anything like that. I look at the long-term trends. What's humanity going to do as a group over time? What's going to be the overwhelming majority of something at whatever point that is? Amazon is going to continue to be useful. It's going to continue to abuse its workers. It's going to continue to be a piece of crap in some ways. It's also going to continue to do whatever charity stuff it's doing, like every other business. It's the whole give take. They all do good. They all do bad. Whatever. I'm just trying to profit off of it so that I can make some better change in the world. Like if you want to make some good change in the world, you can take the money from the system that's making these bad decisions and put it into the things that are making good decisions. And that's what I'm trying to do ultimately. So if I have to buy a stock like this that maybe I morally am not okay with, but at the same time, it's not like it's that bad compared to what else could be around. If you're giving it anything, like anything that exists, any system we already have, yeah, it's not perfect, but it's working. So it's what we have for now. You can either cry about it or you can do something about it. And my plan is to do something about it with the earnings I get from this. So that's what I'm doing. I'm looking at stocks like this and I'm buying them because they're not the devil. They're not some evil thing, whatever people want to say, some terrible. I mean, maybe they are. They aren't, whatever. It's too early to tell on the Twitter thing for Elon Musk and that. So I'm just going to sit back and watch and see what happens to it. It's a chance for competitors to pop up too. I mean, we already kind of had that. Like, we have censorship on both sides, and they're both talking about how the other one's censoring each other and stuff like that. So there's all these new startups that are coming up that are going to compete with it too. And there's fuel into ones that have been going for a while that haven't had a chance. So it's too early to tell what's going to happen. Twitter could go away. Twitter could become a powerhouse. Twitter could be amazing. Twitter could be terrible. Twitter could be eh. My guess it's going to be eh. I really think that's what's going to happen. Like, there's going to be some good stuff and some bad stuff that comes from it, and then it's just going to be eh. Because you know what Twitter was before this? It was eh. It's just a different kind of eh. This time it's the kind of eh that, like, these people like and these other people don't like. I don't care. Twitter's my least favorite platform. All I ever get is people trying to sell me shit. Hey, look, there's this trading strategy that'll make you $100K in a week. No, it won't. That doesn't happen, okay? You don't make $100K in a week from a trading strategy. I don't care if you're using $1 billion. It doesn't happen. I mean, if you're using that, you could. But the point is, like, for the people that you're trying to reach, they're not going to make $100K in a week. These people that have $200 and nothing else, they're not going to make $100K. They're going to lose that $200. They're going to put more in. They're going to lose that too. And then they're going to be disheveled and hate it. And never come back. Actually come back later when things go up. So these strategies are fake, and that's all I ever get on Twitter. I don't get that on the other ones. I've started using the other platforms a little bit. They're not as bad. I mean, you get some ads, you can go right through them. It's been kind of nice. That's the one thing, like, I think YouTube has a disadvantage because it has to show these long ads all the time. But, like, all these other platforms that use ads don't have to do it in the same way. I mean, do you ever, like, you watch a YouTube video if you don't actually have premium and you're watching the ads? You see a video, you see a commercial so long that inside you just hurt. Like, it physically hurts to watch this video. You're like, oh, this is only like a 3-minute video. Why am I watching a 30-second ad that I can't skip? Or a 15-second ad that I can't skip? It, like, hurts to do that. But these other platforms, you can kind of skip the ads or you can go right by them. So you see them, they're in your psyche, but you just don't have to sit through them. You don't have to have that, like, visceral pain when you're watching a video you actually want to watch. So I think there's so much room for all these other platforms to take over. There's room for Twitter to grow. There's finally a chance for it to change because the only way something changes is if you change who's at the helm. So that's what they did and kind of came in there and fired everybody starting from scratch. So it's too early to tell. Is it going to impact Tesla? That was one thing I was going to talk about, but I never did. It might. If Elon Musk needs money, most of his wealth is tied up in Tesla. He might have to take from Tesla, which could drop it. And the thought of that will cause people to sell, and it already has. That's what a lot of the people selling are thinking. They're thinking, man, this Twitter's going to be a money sink until they figure it out, if they figure it out. So where's that money going to come from if things get bad? Because some of it is borrowed money. The rest of it's going to come from wherever wherever the least amount of pressure is to get to, and that's Tesla shares. There's a ton of value in those shares and a high liquidity. So there's a good chance that they could be sold. So what do you have down here from Salome Fishby? I think the influence of Twitter is overestimated by people that aren't in the media, content creators, celebs, etc. Yeah, I agree with you. I think a lot of like Twitter is one of those ones that people either really viscerally hate or they're just okay with. You know, like people that make money off of it, yeah, they love Twitter, they like Twitter. But most people are like, it's okay, or I hate it. So I think you're absolutely right about that. I don't think it has as much influence as some of the other platforms, but it does have some. You know, the advantage of it is it's quick. It's one of the quicker platforms. The fact that you have things in a narrower package means that you can get information across faster when it happens. Whereas like on YouTube, people have to make a video, they have to put it out. Maybe they live stream, they have to set all that stuff up. But, you know, with Twitter, you can just, boom, send the information out and it's done. So there's usefulness in that compared to some of the other platforms. But the same thing can be done on any platform. Like, you could do that on Instagram. You could do that on TikTok and YouTube and Facebook. Like, they have that ability. It's just it's not centered around that quick burst of information. Like, I guess that's kind of what Twitter is. It was, like, originally sort of just a consolidated information machine. You know, so it's difficult to know which way anything's going to go early on. So with something like this, I say it's better not to get your opinion involved in it yet. Like, don't just let the conversation play out. Look for the good and the bad on every side of the thing and kind of let it settle, and then we'll see what it's going to be. What I think is actually going to happen is the media focus is just going to move to something else, and this Twitter thing is going to go on for a while, but it's just not going to be the thing people talk about. Because honestly, being on Twitter, you know, before and after this happened, because I never really used Twitter that much until I started doing this whole thing. It didn't really change very much. You know what I mean? It's basically the same thing. I open the feed and see the same kind of stuff I was seeing before that. I haven't had anything. I haven't gotten kicked off or have to pay or any of this stuff. Just kind of there. You know, it's the same exact thing. So I think people overestimate everything, like you're saying, Salome. I also think that it's within our nature to get more hyped up about things and to take things personally. You know, like the whole point I was making earlier about the thing that the public doesn't want to happen and doesn't think will happen combined is the thing that happens. Like, that's exactly why Twitter did what it did. You know, because it was so reprehensible to some people or so necessary to other people. It had to be a certain way, and it couldn't be a certain way, and people didn't want it to be, or they wanted it to be. They willed it into existence because there was so much of that focus on it that it happened. You know, if this whole thing didn't go down the way it went down, like Twitter would still be doing exactly what it was doing before. Elon Musk just kind of got stuck in it because he was doing too well at the time and he got cocky and was like, oh man, now I actually got trapped in something. Because I think he was like Trump. I think he was just trolling, trying to get in, and then it happened. And he's like, oh crap, what do I do now? It's like that whole thing. So, all right, now, like I've said, I'm winding down. We're talking about a bunch of the stuff. We talked about some stocks. We talked about FTX. It's really dumb. Sam Bankman-Fried's a terrible person. I always thought he was. That's the other point I never finished. When the market was going down in crypto, they continued to spend money. And they needed, usually when the market's going down, you don't have extra money to spend. But they were acting like they did. And that told me something was weird. Right? Because they should have been pulling back on their spending like everybody else, but they didn't. They continued to do it. So that, to me, that's suspicious as hell. When your industry is in a free fall and you're just throwing around money like it's no big deal and not changing what you're doing at all, that's a red flag. That's a huge red flag, especially if you're new. Like FTX was only a couple of years old. You know, and there's the whole like tie to Alameda Research, which is Sam Bankman-Fried's thing, and it's just, oh my, they held a huge stake in it. BlockFi held a huge stake in it. It's just a mess. It's an absolute mess. So we talked about that. We talked about some stocks. Oh, the only other stock that I wanted to talk about was Alibaba. So let me do that real quick before we move on. So Alibaba was another one of my wins. Like I said, I had a bunch of wins this week, which is really, really great. I mean, I made that money back from the Fed meeting, and I've been making profits on all these, and also I'm still holding some of these. But Alibaba, man, I did the thing again. Every time I buy Alibaba, I tend to buy it at the lows. I bought it somewhere in this candle right here. This is a week's worth of time. So somewhere in this range, I bought some Alibaba contracts, and it popped up, and I almost sold some when it was at the peak, but I was like, I just want to see if this goes a little more. So I'm holding some Alibaba right now. I think I probably should have sold. It's got a little bit more pressure than the rest of the market, because not only does it have the stuff that we're dealing here with in the U.S., that also has the pressure of the stuff that is happening in China. So U.S. listed stocks that are in other companies have dual pressure. They have pressure from whatever's happening here and whatever's happening there. So if something happens in China but everything's fine in the U.S., you can see U.S. stocks pump and then Chinese stocks go down. So it's good to have some exposure to other places, which is why I like Alibaba. And at some point, I'd actually like to have some shares in it. But at this point, I just wanted to get, I wanted to get on a swing trade, and man, I got it at the right time. So hopefully, it doesn't come all the way back down here. That'll kind of suck. But at some point, if we balance, man, having these contracts is going to be great. I probably will take some profit if we go sideways for a while. I think I'm just going to unload a little bit of it because I really should have unloaded at least a couple up here, but I didn't. But man, those contracts like doubled. It was amazing. So great to buy those at just the right time. So that was the other stock that I wanted to talk about, and we were talking about layoffs and buybacks. So okay, Chef Brandon, I was telling you earlier that I wanted to talk about those layoffs and buybacks. So there's a choice with the money that these companies have. They can either pay for real things, real improvements. They can make real improvements to their business, or they can buy stock back. And it's not always that choice. Usually you should do a little bit of both. Like sometimes it's pointless to put money into building new things when there's not demand or something like that. So in some cases, it's better to actually buy some stock back instead of put money into the company. But a lot of times it's like, okay, we're making this much. We could be producing this much more if we had, just these few things in place. So it makes sense to do that because it makes exponentially more money than you use to put into it. But other times that isn't the case. And sometimes companies will just take all the money and buy their stock back because they're on the board of directors. So whatever the performance of the stock is reflected in their pay. So that's one thing other people don't realize. They think all these CEOs just magically get like millions of dollars for nothing. Like, no, it's actually most of what they get paid is based on performance. There's a little bit that you have to have some kind of job security. So a lot of these contracts they get paid in some way, like, athletes, it's the same way. They get paid for going to a team, but then they also have a performance-based aspect that says, if you get this much of something or this much of something, then we give you a bonus. It's the same way with CEOs. The better the stock does, the more money they can make on their own pay. So they have incentive to do that. So that's why sometimes there'll be a choice between paying workers more or improving the company or something like that, or raising the stock price. Because it doesn't matter if to the CEOs and stuff if people get paid another dollar or the same. If the stock price goes up, they still make money. So they can choose between those things, and that's the bad part. That's the part that they're trying to deal with this whole taxing buybacks, which I don't think is necessarily a bad idea, honestly, because some of these taxes are not a whole lot, but they add up on large amounts. So it's incentive to be like, okay, do some, because that keeps everybody's retirement going. It keeps the asset appreciation going. So I do want buybacks to be had. If employees own stock in the company, they want that to happen too, because that means the value of their stock goes up as well. And like half the country owns stock, so it raises the value of all those assets held by those people. But at the same time, you want the performance and you want to be fair to the workers because you want to keep your business going. If you screw your workers, then they're not going to want to work for you, and they're going to do a terrible job, and you're not going to be able to produce a superior product. So you have to have a balance of everything. You have to make sure you take care of the workers so the product is good and they're happy and it's morally the right thing to do as well. You also have to make sure you're taking care of the business. You have everything you need. You're making the upgrades you need. And you have to make sure you're taking care of the stock so that people that own it, the people that support you, the people that give you the money to make these changes are getting rewarded as well. So everybody is getting rewarded if the balance is right. But if the balance is not right, then you have problems, and that's why we have the problems we have today. Is because people are taking advantage of that, and you can't. The problem with like either opening up a system completely or regulating it into oblivion is that you're gonna lose something if you go in either direction. The best way to have all the options is to let it be as open as you possibly can. But personally, like on a personal level, make sure you do the right thing so that there is an incentive to lock features up. Because when you do the wrong thing and you cause people to want to lock it up, then you start sending it into this cycle of super regulation and no regulation. Because if you over-regulate, there's going to be a backlash to it, and then you're going to under-regulate, and you're going to see the problems of both of those. But if you're responsible with what you do, then you have a nice open system, then you can actually make the moves you need to make without things being restricted. However, that's not the system we live in. Things are going to be restricted because people are greedy and because the system sets it up so that people kind of have to be greedy in some ways. Like some people are just unfortunate and they need to get ahead, and they're not going to take responsibility if they see a way to finally get ahead and get out of the pain of being where they are. So if you have a more fair system, then something like that works. But because we have an unequal system, there's going to be the volatility seen by these things. So layoffs and buybacks. Chef Brandon was predicting that we were going to see a lot of that. And the reason we're going to see that is because, one, the stock is going down, so there's incentive to raise the stock. And two, they need to cost cut in the real economy because demand has slowed. So that's exactly what the Fed was trying to do. They wanted to slow demand. Demand had been slowed, and now we're reacting to that. People are getting laid off because there's less demand. There's less cash in the system because there's less demand, and there's less demand because cash is more expensive, and there's also less demand because things have gone down. People don't have the confidence that they want to buy things, whether it's in the economy or in the markets. Confidence to buy things has dropped quite a bit. So I've been rambling quite a bit. I think I've pretty much gotten through everything. There's still so much to talk about. So I'm working on getting some of these thoughts out in some shorter videos and putting them on social media. I'm only on once every other week. So there's not a lot of time for people to get my message on Twitch live. But if you go on YouTube, there's a bunch of videos on there. If you go onto Instagram, I have links in the description down there. It's all these things. There's a link to the Discord. If you want to come in and talk about stocks in the Discord, everyone's more than welcome. I mean, all levels. This is not a place where you're going to be like super advanced, right? If there are super advanced people that want to come in and hang out, great, please do it. But for the most part, it's just people that want to learn. That's what I want to do. I'm an intermediate trader that wants to learn this, and I want to talk to other people that are interested in the same thing. Because if we work together, we can all make money. I'm trying to just make some money. I'm trying to learn. Anybody else that wants to, come join, hang out in any of the social media platforms, hang out in the Discord. Love to have you there. I'm a Stockalypse. This is Sunday Night Finance. I do this every other week, Sunday, 3 p.m. Pacific. We watch the futures open and then basically talk about all the stuff that I want to talk about for the week, which would be my trades, which would be what happened in the news, which would be what we think is going to happen in the future. So I'm going to get out of here. I'll see you later. Have a good weekend. Hopefully everybody's been safe. Be prepared for an interesting last month, because this is a tax loss selling year at this point. We could see some serious downtrends. We can see some serious bounces. Volatility is going to be high. We have one more Fed meeting to go, so we're not out of the woods yet, but we're getting there. So be prepared. Be prepared. This is going to be insane. We've been waiting all year for this moment. All right, I'll talk to you later. Have a good weekend.